Like world-class bridge player Richard Zekhauser, Charlie scores himself not so much on whether he won the hand, but rather on how well he played it. While poor outcomes are excusable in the Munger-Buffett world, given the fact that some outcomes are outside of their control, sloppy preparation and decision-making are never excusable because they are controllable. Properly playing the hand. The right way to think is the way Zekhauser plays bridge. It's just that simple. Most players gain pleasure from feeling accepted or belonging to the group. The good player, however, gains pleasure from his ability to cope with the realities of the game. In investing, just as in baseball, to put runs on the scoreboard, one must watch the playing field, not the scoreboard. On those relatively few occasions when all the circumstances are just right and Charlie does invest, he will likely make a large, decisive bet. He does not pick around the edges, take initial positions, or make small, speculative investments. Such behavior implies uncertainty, and Charlie's moves, few as they are anything but uncertain. As he says, he practices extreme patience combined with extreme decisiveness. Charlie's self-confidence is based not on who or how many agree or disagree with him, but on his ability to objectively view and measure himself. This self-mastery affords him rare objectivity in gauging his actual knowledge, experience, and correctness of thought. Again, we see the important role played by the right kinds of temperamental qualities: self-discipline, patience, calm, independence. Charlie's level of investment performance is arguably impossible without them. Okay, it's a good company. But is the price low enough? Is the management made up of people Munger and Buffett are comfortable with? If it is cheap enough to buy, is it cheap for the wrong reason or the right reason? What's the flip side? What can go wrong that I haven't seen? What makes a great business model for Charlie? His recommended reading materials, see Appendix, provide some guidance. Guns, Germs, and Steel, The Selfish Gene, Ice Age, and Darwin's Blind Spot all have a certain theme: a focus on the aforementioned issue of competitive destruction, and an examination of why some entities are nevertheless able to adapt, survive, and even dominate over time. When this theme is extrapolated into investment selection, the preferred Munger business emerges. Some thrive by outcompeting La Selfish Gene, and others by out-cooperating Darwin's Blind Spot. Once again, we see Charlie's rich fluency across a broad range of disciplines at work. How many investors ever consider, as Charlie routinely does, such a broad and sophisticated spectrum of factors? To name but a few, he routinely considers factors such as conversion, i.e., how the laws of thermodynamics intersect with laws of economics. For instance, how paper and petroleum become a newspaper delivered to a front door. Psychological tendencies and incentives, notably the extreme behavioral pressures they create, both good and bad, and fundamental sustainability over time. The constant and often deadly interplay between positive factors such as moats and the ravages of competitive destruction. Charlie is possibly without peer when it comes to the checklist of atypical investment factors he considers, and his deep fluency in the diverse disciplines from which they are drawn. All intelligent investing is of value. Investing, acquiring more than you are paying for. You must value the business in order to value the stock. Price is what you pay, value is what you get. On several occasions, incurring the skepticism that must often be borne by value-style investors, the United States has made astute territorial acquisitions. In 1803, Thomas Jefferson's administration completed the Louisiana Purchase from Napoleon, France, for the sum of $15 million, which worked out to roughly 2.9 cents an acre. In 1867, in what at the time was known as Seward's Folly, The U.S. acquired the territory of Alaska from Russia for the sum of $7.2 million in gold, or roughly 2.5 cents an acre. By way of comparison, the Alaska purchase price in 2006 dollars is the equivalent of $1.67 billion. Certainly no folly in terms of the value of oil, minerals, and strategic advantages obtained. People always want a formula, but it doesn't work that way. You have to estimate total cash generated from now to eternity and discount it back to today. Yardsticks such as PEs are not enough by themselves. Buffett. You need a different checklist and different mental models for different companies. I can never make it easy by saying, here are 3 things. You have to derive it yourself to ingrain it in your head for the rest of your life. Munger. An investing principles checklist. No Weisbelot, no matter how great his talent and experience, fails to use his checklist. We have now examined Charlie's approach to thinking in general and to investing in particular. In keeping with our intent to observe how he seems to do it, we will recap his approach by using the checklist methodology he advocates. For Charlie's own words of wisdom on the value and importance of checklists, see Talk 5 and page 320. Note, however, that the following principles are most certainly not employed by Charlie in a one-by-one or one-time fashion, as the checklist format might seem to imply. Nor can they necessarily be prioritized in terms of any apparent or relative importance. Rather, each must be considered as part of the complex whole or gestalt of the investment analysis process, in much the same way that an individual tile is integral to the larger mosaic in which it appears. Risk-call investment evaluations should begin by measuring risk, especially reputational. Incorporate an appropriate margin of safety, avoid dealing with people of questionable character, insist upon proper compensation for risk, assumed. Always beware of inflation and interest rate exposures. Avoid big mistakes, shun permanent capital loss. Risk-call investment evaluations should begin by measuring risk, especially reputational. Incorporate an appropriate margin of safety. Incorporate an appropriate margin of safety. Avoid dealing with people of questionable character. Avoid dealing with people of questionable character. Insist upon proper compensation for risk assumed. Insist upon proper compensation for risk assumed. Always beware of inflation and interest rate exposures. Always beware of inflation and interest rate exposures. Avoid big mistakes, shun permanent capital loss. Avoid big mistakes, shun permanent capital loss. Independence only and fairy tales are emperors told they are naked. Objectivity and rationality require independence of thought. Remember that just because other people agree or disagree with you doesn't make you right or wrong. The only thing that matters is the correctness of your analysis and judgment. Mimicking the herd invites regression to the mean, merely average performance. Independence only and fairy tales are emperors told they are naked. Objectivity and rationality require independence of thought. Objectivity and rationality require independence of thought. Remember that just because other people agree or disagree with you doesn't make you right or wrong. The only thing that matters is the correctness of your analysis and judgment. Remember that just because other people agree or disagree with you doesn't make you right or wrong. The only thing that matters is the correctness of your analysis and judgment. Mimicking the herd invites regression to the mean, merely average performance. Mimicking the herd invites regression to the mean, merely average performance. Preparation. The only way to win is to work, 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 and hope to have a few insights. Develop into a lifelong self-learner through voracious reading. Cultivate curiosity and strive to become a little wiser every day. More important than the will to win is the will to prepare. Develop fluency in mental models from the major academic disciplines. If you want to get smart, the question you have to keep asking is, why? Preparation. The only way to win is to work, and hope to have a few insights. Develop into a lifelong self-learner through voracious reading. Cultivate curiosity and strive to become a little wiser every day. Develop into a lifelong self-learner through voracious reading. Cultivate curiosity and strive to become a little wiser every day. More important than the will to win is the will to prepare. More important than the will to win is the will to prepare. Develop fluency in mental models from the major academic disciplines. Develop fluency in mental models from the major academic disciplines. If you want to get smart, the question you have to keep asking is, why? If you want to get smart, the question you have to keep asking is, why? Yep. Intellectual humility. Acknowledging what you don't know is the dawning of wisdom. Stay within a well-defined circle of competence. Identify and reconcile disconfirming evidence. Resist the craving for false precision, false certainties, etc. Above all, never fool yourself, and remember that you are the easiest person to fool. Intellectual humility. Acknowledging what you don't know is the dawning of wisdom. Stay within a well-defined circle of competence. Stay within a well-defined circle of competence. Identify and reconcile disconfirming evidence. Identify and reconcile disconfirming evidence. Resist the craving for false precision, false certainties, etc. Resist the craving for false precision, false certainties, etc. Above all, never fool yourself, and remember that you are the easiest person to fool. Above all, never fool yourself, and remember that you are the easiest person to fool. Yep. Analytic rigor. Use of the scientific method and effective checklists minimizes errors and omissions. Determine value apart from price, progress apart from activity, wealth apart from size. It is better to remember the obvious than to grasp the esoteric. Be a business analyst, not a market, macroeconomic, or security analyst. Consider totality of risk and effect. Look always at potential second-order and higher-level impacts. Think forwards and backwards. Invert, always invert. Analytic rigor. Use of the scientific method and effective checklists minimizes errors and omissions. Determine value apart from price, progress apart from activity, wealth apart from size. Determine value apart from price, progress apart from activity, wealth apart from size. It is better to remember the obvious than to grasp the esoteric. It is better to remember the obvious than to grasp the esoteric. Be a business analyst, not a market, macroeconomic, or security analyst. Be a business analyst, not a market, macroeconomic, or security analyst. Consider totality of risk and effect. Look always at potential second-order and higher-level impacts. Consider totality of risk and effect. Look always at potential second-order and higher-level impacts. Think forwards and backwards. Invert, always invert. Think forwards and backwards. Invert, always invert. Yep. Allocation. Proper allocation of capital is an investor's #1 job. Remember that highest and best use is always measured by the next best use, opportunity cost. Good ideas are rare. When the odds are greatly in your favor, bet, allocate. Heavily, don't fall in love with an investment. Be situation dependent and opportunity driven. Allocation. Proper allocation of capital is an investor's #1 job. Remember that highest and best use is always measured by the next best use, opportunity cost. Remember that highest and best use is always measured by the next best use, opportunity cost. Good ideas are rare. When the odds are greatly in your favor, bet, allocate heavily. Good ideas are rare. When the odds are greatly in your favor, bet allocate heavily. Don't fall in love. With an investment, be situation-dependent and opportunity-driven. Don't fall in love. With an investment, be situation-dependent and opportunity-driven. Patience resists the natural human bias to act. Compound interest is the eighth wonder of the world. Einstein. Never interrupt it unnecessarily. Avoid unnecessary transactional taxes and frictional costs. Never take action for its own sake. Be alert for the arrival of luck. Enjoy the process along with the proceeds, because the process is where you live. Patience resists the natural human bias to act. Compound interest is the eighth wonder of the world. Einstein. Never interrupt it unnecessarily. Compound interest is the eighth wonder of the world. Einstein. Never interrupt it unnecessarily. Avoid unnecessary transactional taxes and frictional costs. Never take action for its own sake. Avoid unnecessary transactional taxes and frictional costs. Never take action for its own sake. Be alert for the arrival of luck. Be alert for the arrival of luck. Enjoy the process along with the proceeds, because the process is where you live. Enjoy the process along with the proceeds, because the process is where you live. Decisiveness. When proper circumstances present themselves, act with decisiveness and conviction. Be fearful when others are greedy, and greedy when others are fearful. Opportunity doesn't come often, so seize it when it does. Opportunity meeting the prepared mind. That's the game. Decisiveness. When proper circumstances present themselves, act with decisiveness and conviction. Be fearful when others are greedy, and greedy when others are fearful. Be fearful when others are greedy, and greedy when others are fearful. Opportunity doesn't come often, so seize it when it does. Opportunity doesn't come often, so seize it when it does. Opportunity meeting the prepared mind. That's the game. Opportunity meeting the prepared mind. That's the game. Change live with change and accept unremovable complexity. Recognize and adapt to the true nature of the world around you. Don't expect it to adapt to you. Continually challenge and willingly amend your best-loved ideas. Recognize reality even when you don't like it, especially when you don't like it. Change live with change and accept unremovable complexity. Recognize and adapt to the true nature of the world around you. Don't expect it to adapt to you. Recognize and adapt to the true nature of the world around you. Don't expect it to adapt to you. Continually challenge and willingly amend your best-loved ideas. Continually challenge and willingly amend your best-loved ideas. Recognize reality even when you don't like it, especially when you don't like it. Recognize reality even when you don't like it, especially when you don't like it. Focus, keep things simple, and remember what you set out to do. Remember that reputation and integrity are your most valuable assets and can be lost in a heartbeat. Guard against the effects of hubris and boredom. Don't overlook the obvious by drowning in minutiae. Be careful to exclude unneeded information or slop. A small leak can sink a great ship. Face your big troubles. Don't sweep them under the rug. Focus, keep things simple, and remember what you set out to do. Remember that reputation and integrity are your most valuable assets and can be lost in a heartbeat. Remember that reputation and integrity are your most valuable assets and can be lost in a heartbeat. Guard against the effects of hubris and boredom. Guard against the effects of hubris and boredom. Don't overlook the obvious by drowning in minutiae. Don't overlook the obvious by drowning in minutiae. Be careful to exclude unneeded information or slop. A small leak can sink a great ship. Be careful to exclude unneeded information or slop. A small leak can sink a great ship. Face your big troubles. Don't sweep them under the rug. Face your big troubles. Don't sweep them under the rug. Charlie sums it up. How do some people get wiser than other people? Partly it is inborn temperament. Some people do not have a good temperament for investing. They're too fretful, they worry too much. But if you've got a good temperament, which basically means being very patient, yet combine that with a vast aggression when you know enough to do something, then you just gradually learn the game, partly by doing, partly by studying. Obviously, the more hard lessons you can learn vicariously, instead of from your own terrible experiences, the better off you will be. I don't know anyone who did it with great rapidity. Warren Buffett has become one hell of a lot better investor since the day I met him, and so have I if we had been frozen at any given stage. With the knowledge hand we had, the record would have been much worse than it is. So the game is to keep learning, and I don't think people are going to keep learning who don't like the learning process. Understanding both the power of compound interest and the difficulty of getting it is the heart and soul of understanding a lot of things. Since human beings began investing, they have been searching for a magic formula or easy recipe for instant wealth. As you can see, Charlie's superior performance doesn't come from a magic formula or some business school-inspired system. It comes from what he calls his constant search for better methods of thought, a willingness to prepay through rigorous preparation, and from the extraordinary outcomes of his multidisciplinary research model. In the end, it comes down to Charlie's most basic guiding principles, his fundamental philosophy of life: preparation, discipline, patience, decisiveness. Each attribute is in turn lost without the other, but together they form the dynamic critical mass for a cascading of positive effects for which Munger is famous, the Lollapalooza. Finally, a word or two on why this overview of Charlie's investment philosophy has focused so much on the subject of what to buy and so little on when to sell. The answer, in Charlie's own words, serves as a wonderful summation of the Munger school of highly concentrated, focused investing described here. We are partial to putting out large amounts of money where we won't have to make another decision. If you buy something because it's undervalued, then you have to think about selling it when it approaches your calculation of intrinsic value. That's hard. But if you can buy a few great companies, then you can sit on your ass. That's a good thing. Like his hero, Benjamin Franklin, Charlie Munger painstakingly developed and perfected unique approaches to personal and business endeavors. Through these methods, and the development and maintenance of sound, lifelong habits, he has achieved extraordinary success. And so these complex, aging prodigies carefully tend their compound interest machine, a joint creation of two exceptional personalities. Others may try to duplicate Berkshire Hathaway, but they won't be able to duplicate these two exceptional minds. Robert Lenzner and David S. Fondler. Honesty is the best policy. Consistent with his Midwestern roots, honesty and integrity and Charles Munger have always been synonymous. As Charlie once said, doing the right thing can pay big dividends both personally and professionally. As a testimonial to just how deeply honesty and integrity are ingrained in Charlie, his daughter Wendy recalls the Watergate era and the sympathy she had for the daughters of Richard Nixon, as their father's ethical lapses became known. Elle knew without a doubt that my dad would never put us in a similar situation. I can't tell you how wonderful that made me feel. We asked legendary fixed-income expert Bill Gross of PIMCO to comment on Charlie and honesty. Here is what he had to say. When the East and the West coasts fall into the sea, either through storm, earthquake, or a deterioration of values, there will still be Munger's Omaha. Charlie's ethical standards should be beamed by satellite to all global financial centers to prevent future Enrons and WorldComs. What fine examples and teachers Charlie and Warren are, especially for young people. As Albert Schweitzer said, example is not the main thing in teaching, it is the only thing. Charlie and Warren, in a lifetime business race, have not only finished up front, but have never cut any corners along the way. One could not find more exemplary, honest Abes in the financial world than Warren Buffett and Charlie Munger. Their annual reports are legend, and they contain not only words of bona fide investment wisdom, but self-recrimination when deemed necessary. I think track records are very important. If you start early trying to have a perfect one in some simple thing like honesty, you're well on your way to success in this world. Charles T. Munger. Rick Guerin, longtime friend and business associate, adds, on 2 occasions, I saw Charlie pay more than he needed to in business transactions. First, with 2 little old ladies who held notes in a business we were buying, which we could have easily redeemed at far less than face value. Charlie nevertheless paid them face value. Second, to raise some cash I needed for another investment, I offered to sell him my half of a venture we were in together, and he said to set a fair price. I said $130,000. He said no, $230,000 was correct, and he paid me that. This also presented Charlie with the opportunity to use one of his favorite lines. I'm right, and you're smart, and sooner or later you'll see I'm right. Of course, he was right on both scores. He had set a more accurate price, and I did eventually come to see it that way. Taking advantage of a cheap stock price on the stock exchange is one thing, but taking advantage of partners or old ladies is something else, something Charlie just doesn't do. Charlie on Honesty, 2004 Wesco meeting. Louis Vincenti, who used to sit in the chair I occupy today, used to say, if you tell the truth, you don't have to remember your lies. So we try and keep it simple by telling it like it is at all times. Having so many long-time loyal shareholders means that we have never given a damn whether any quarter's earnings were up or down. At least, we don't care in terms of their effect on shareholders. We prefer profits to losses, obviously. But we're not willing to manipulate in any way just to make some quarter look a little better. And that's a very different ethos from the standard. And in terms of intellectual content, I think this place tries harder to be rational than most places. And I think it tries harder than most places to be ethical, meaning to tell the truth and to not be abusive. Now with 175,000 employees, or something like that, at Berkshire, I'll bet as I sit here at least one of them is doing something that I would very much regret. However, despite the presence of some human failing, we've had an amazingly low amount of litigation or scandal, or anything of that sort over a vast number of decades. And people notice that. We think there should be a huge area between what you're willing to do and what you can do without significant risk of suffering criminal penalty for causing losses. We believe you shouldn't go anywhere near that line. You ought to have an internal compass. So there should be all kinds of things you won't do, even though they're perfectly legal. That the way we try to operate. Don't think we deserve a lot of credit for that because we early understood that we'd make more money that way. And since we understood it so well, I'm not sure that we're entitled to credit for such morality as we have. Of course, it is hard to know your own motivations. But I'd like to believe that we'd all behave well even if it didn't work so well financially. And every once in a while, we get an opportunity to behave that way. But more often, we're made extra money out of morality. Ben Franklin was right for us. He didn't say honesty was the best morals. He said it was the best policy. Our first, I have nothing to add. On occasion, Charlie will pose a challenging question to his audience or receive one and leave it unanswered. By so doing, he says, he encourages his listeners to reach for the answers themselves and, as a result, better learn and retain the information they discover. Charlie says his father routinely used this same technique with him, with results that still benefit him today. In keeping with the promise of this book to present the wit and wisdom of Charlie Munger, we consider it a responsibility and duty to once and for all provide answers to some of the riddles and questions Charlie has long left us reaching for, but never quite grasping. We begin with this question from the talk Charlie gave at the Harvard Faculty Club, October 6, 1994. The Psychology of Human Misjudgment. Question: you cite the Warren Buffett rule for outcry auctions. Don't go. Then you say, we don't go to the closed bid auctions either, but for a different reason, one which Zeckhauser would understand. Answer: Zeckhauser Ray Chess is the Harvard professor, who is also a great bridge player. The problem, a different one, with closed bid auctions is that they are frequently won by people making a technical mistake, as in the case of Shell paying double for Belridge Oil. You can't pay double the losing bid at an open outcry auction. You don't have that problem, you have different ones. But closed bid auctions invite a possibility for big mispricing errors. Look for more, I have nothing to add, moments sprinkled throughout the book. Chapter 3. Mungerisms. Charlie unscripted highlights from recent Berkshire Hathaway and Wesco financial annual meetings by Whitney Tilson. The wisdom of the wise and the experience of ages may be preserved by quotations. Isaac Disraeli. Warren Buffett and Charlie Munger are undoubtedly the greatest investment duo ever, so any investor who fails to learn as much as possible about these two men and how they achieved their success is, to use one of Charlie's favorite words, bonkers. But the real joy of studying Warren and Charlie is not that one can learn a great deal about how to compound money at a high rate for an extended period, though this is certainly a nice side benefit. Rather, by absorbing their teachings, one will gain a far deeper understanding of the human condition, the state of the world, how to think rationally, and most importantly, how to better lead a life of integrity, happiness, and kindness. Here's a hint. These characteristics are intertwined. Learning from Warren isn't hard. There are many books about him. He regularly gives speeches, writes articles, and makes public appearances. And he's published lengthy annual letters for decades. You can read the last 30 of them for free at www.berkshirehathaway.com. If you haven't done so already, what are you waiting for? But Charlie is more private. There are only 2 books about him, and he is a far less prolific writer and speaker. For this reason, many people fail to recognize that Charlie is a genius in his own right, and that he has had a profound effect on Warren's investment philosophy, which Warren freely acknowledges. The dynamic between them is pretty funny to watch. On stage at the Berkshire annual meeting, Warren generally takes the first stab at answering a question, but then usually turns and says, Charlie. Immobile and expressionless, they could easily substitute a mannequin for him, and no one would notice most of the time. Charlie typically replies, I have nothing to add. Those 5 words have become a trademark of Charlie's hat, often delights both Warren and the audience. In fact, at the special meeting for the Gen Ray acquisition in September 1998, Warren actually showed up with a cardboard cutout of Charlie and a recording of Charlie saying, I have nothing to add. According to one of my friends in attendance, Warren would get that impish look each of the half-dozen or so times he used it. Those words also reflect both Charlie's abrupt, curmudgeonly nature, at least that's his public persona, and the two minds as one relationship of brilliant partners joined in their thoughts. But when Charlie does have something to add, it is often piercing and insightful, and he doesn't pull any punches. To use his own words, Charlie is a cranky, old-fashioned man and has never worried about being politically correct. He just calls it the way he sees it. Since Warren does most of the talking at the Berkshire meeting, I always like to attend the Wesco annual meeting a few days later in Pasadena to hear Charlie's in-depth thinking. He is the chairman of Wesco Financial, a holding company with a structure similar to Berkshire's, which owns 81% of Wesco. One needn't even be a shareholder to attend. Charlie, as he and Warren do at the Berkshire meeting, welcomes all pilgrims to the church of Graham, Dodd, Buffett, and Munger. I've never regretted making the cross-country trip so soon after returning from Omaha, as Charlie's mind remains in peak form. During the 2003 meeting, as Charlie made one insightful observation after another, one of my friends leaned over and whispered to me, "This is one unbelievable 80-year-old." Indeed. As a teacher and a thinker, Charlie is Warren's equal, and I've learned an enormous amount from him, which is why I was so delighted to hear that Peter Kaufman was pulling this book together, and why I immediately agreed to contribute. This chapter is intended to complement Charlie's formal writings and speeches that appear elsewhere in this book. Drawn from my notes from the Berkshire and Wesco annual meetings over the past 5 years, this is a collection of the most insightful, provocative, spontaneous, funny things Charlie said at these meetings. Since almost all of his remarks are in response to questions from shareholders, he comments extensively on Berkshire Hathaway and many business and investing-related topics. To make Charlie's teachings more accessible, I've organized them by topic and also done some light editing, but the goal is to let him speak for himself. Enjoy. I have been associated for many years with a man legendary for good judgment, and it never ceases to amaze me to see how much territory can be grasped if one merely masters and consistently uses all the obvious and easily learned principles. Munger. 101. Keys to our success. 1. It is occasionally possible for a tortoise content to assimilate proven insights of his best predecessors, to outrun hares that seek originality or don't wish to be left out of some crowd folly that ignores the best work of the past. This happens as the tortoise stumbles on some particularly effective way to apply the best previous work, or simply avoid standard calamities. We try more to profit from always remembering the obvious than from grasping the esoteric. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. 2. We don't claim to have perfect morals, but at least we have a huge area of things that, while legal, are beneath us. We won't do them. Currently, there's a culture in America that says that anything that won't send you to prison is okay. We believe there should be a huge area between everything you should do and everything you can do without getting into legal trouble. I don't think you should come anywhere near that line. We don't deserve much credit for this. It helps us make more money. I'd like to believe that we'd behave well even if it didn't work. But more often, we've made extra money from doing the right thing. Remember Louis Vincent's rule: tell the truth and you won't have to remember your lies. It's such a simple concept. Comments on Berkshire Hathaway. Berkshire is a hell of a business. We're like the hedgehog that only knows one big thing. If you can generate float cash from insurance premiums that Berkshire can invest before claims must be paid, at 3%, and invested in businesses that generate 13%, that's a pretty good business. The businesses that Berkshire has acquired will return 13% pre-tax on what we paid for them, maybe more. With a cost of capital of 3% generated via other people's money in the form of float, that's a hell of a business. That's the reason Berkshire shareholders needn't totally despair. Berkshire is not as good as it was in terms of percentage compounding going forward, but it's still a hell of a business. I hate to be an optimist, but we have added a lot of wonderful businesses to Berkshire over the past few years. Berkshire's past record has been almost ridiculous. If Berkshire had used even half the leverage of, say, Rupert Murdoch, it would be 5 times its current size. Berkshire's future outlook: one of the smartest things a person can do is dampen investment expectations, especially with Berkshire. That would be mature and responsible. I like our model, and we should do nicely. The future will be harder for Berkshire Hathaway for 2 reasons. 1, we're so big. It limits our investment options to more competitive areas that are examined by very smart people like Alice Schroeder, the insurance analyst from Payne Weber, and then Morgan Stanley, who was sitting in the audience. 2, the current climate offers prospects in common stocks over the next 15 to 20 years that are way less than we've experienced over the past 15 to 20 years. Read Warren's Fortune article. I totally agree with it. Mr. Buffett on the stock market, 11/22/99. Berkshire Hathaway's value will be higher in 20 years, but it is certain that the annual rate of percentage growth will be much lower. But this is not a tragedy. We're content. Berkshire Hathaway and Wesco will accumulate cash every year, and we have a structure that gives us enormous flexibility. While we're too big to buy the stock of a small company, we have the advantage of having entire companies offered to us. Something has always turned up for us. I'm not discouraged, but I don't think your money here is going to do anything like what you're used to. It's a finite and very competitive world. All large aggregations of capital eventually find it hell on earth to grow, and thus find a lower rate of return. Personally, I think Berkshire will be a lot bigger and stronger than it is. Whether the stock will be a good investment from today's price is another question. The one thing we've always guaranteed is that the future will be a lot worse than the past. The future returns of Berkshire and Wesco won't be as good in the future as they have been in the past. This is true of all large, successful companies. The only difference is that we'll tell you. Berkshire Hathaway's culture. Our culture is very old-fashioned, like Ben Franklin's or Andrew Carnegie's. Can you imagine Carnegie hiring consultants? It's amazing how well this approach still works. A lot of the businesses we buy are kind of cranky and old-fashioned like us. For many of our shareholders, our stock is all they own, and we're acutely aware of that. Our culture of conservatism runs pretty deep. This is an amazingly sound place. We are more disaster-resistant than most other places. We haven't pushed it as hard as other people would have pushed it. I'm happy having 90% of my net worth in Berkshire stock. We're going to try to compound it at a reasonable rate, with ORT taking unreasonable risk of using leverage. If we can't do this, then that's just too damn bad. Berkshire's and Wesco's stock prices. We like the stocks of both Berkshire and Wesco to trade within hailing distance of what we think of as intrinsic value. When it runs up, we try to talk it down. That's not at all common in corporate America, but that's the way we act. I don't want to go back to Go. I've been to Go. A lot of our shareholders take a majority of their net worth in Berkshire, and they don't want to go back to Go either. Today, it seems to be regarded as the duty of CEOs to make the stock go up. This leads to all sorts of foolish behavior. We want to tell it like it is. Berkshire shareholders. We like our current shareholders and don't want to entice anyone to become one. I think our reporting, considering the complexity of the enterprise, is better than that of any enterprise I know at giving shareholders the information they need. We do it conscientiously. Berkshire's acquisition strategy. 2/3 of acquisitions don't work. Ours work because we don't try to do acquisitions. We wait for no-brainers. Yep. Competition for acquisitions. Yep. We've had private equity competitors for a long time, but one way or another, we've managed to buy quite a few things. The general assumption is that it must be easy to sit behind a desk, and people will bring in one good opportunity after another. This was the attitude in venture capital until a few years ago. This was not the case at all for us. We scrounge around for companies to buy. For 20 years, we didn't buy more than 1 or 2 per year. It's fair to say that we were rooting around. There were no commissioned salesmen. Anytime you sit there waiting for a deal to come by, you're in a very dangerous seat. Yep. Managers of acquired companies. Yep. We've bought business after business because we admire the founders and what they've done with their lives. In almost all cases, they've stayed on, and our expectations have not been disappointed. What matters most, passion or competence that was inborn. Berkshire is full of people who have a peculiar passion for their own business. I would argue passion is more important than brain power. I don't think our managers who come to this meeting are picking up new tricks. They know all the tricks related to their business. But this is an interesting place, and it gets more interesting every year, and they like being part of it. Yep. Managing subsidiaries. Yep. By and large, we've chosen people we admire enormously to have the power beneath us. It's easy for us to get along with them on average because we love and admire them. And they create the culture for whatever invention and reality recognition is going on in their businesses. And included in that reality recognition is the recognition that previous conclusions were incorrect. Yep. It would help current shareholders to hear our CEOs of the Berkshire operating subsidiaries, but we promised them they could spend 100% of their time on their businesses. We place no impediments on them running their businesses. Many have expressed to me how happy they are that they don't have to spend 25% of their time on activities they don't like. Yet, there are certain virtues that are common in all of Berkshire's subsidiaries. We don't create them. We select companies that have them already. We just don't screw it up. We have decentralized power to a point just short of total abdication. Yep. Synergies. Yep. The reason we avoid the word synergy is because people generally claim more synergistic benefits than will come. Yes, it exists, but there are so many false promises. Berkshire is full of synergies. We don't avoid synergies, just claims of synergies. Yep. Making the right personnel decisions. Yep. It's amazing how few times over the decades we've had to remove a person far less than other companies. It's not that we're soft or foolish, it's that we're wiser and luckier. Most people would look back and say their worst mistake was not firing someone soon enough. We don't say that. Our record is fabulous. We're old-fashioned. For example, in the case of CORT Business Services, a furniture rental business that Wesco acquired, Warren said to me, "You're going to love Paul Arnold, Court CEO." And he was right. Paul's been running the business since he was in law school and loves it. Yep. Berkshire's insurance operations. Yep. Reinsurance is not as much of a commodity business as it might appear. There's such a huge time lag between when the policy is written and when it is paid that the customer has to evaluate the insurer's future willingness and ability to pay. We have a reputational advantage, though it's not as big as it should be. I do think we get some advantage in reinsurance because people trust our willingness and ability to pay, so it's not a commodity. I think we have some special talents. That being said, I think it's dangerous to rely on special methods. Better to own lots of monopolistic businesses with unregulated prices. But that's not the world today. We have made money exercising our talents and will continue to do so. I'm glad we have insurance, though it's not a no-brainer, I'm warning you. We have to be smart to make this work. The overall result is that we're going to do pretty well, meaning in the top 10% of the industry, because we do different things, and we're willing to do some unpleasant things. Generally speaking, we're mildly optimistic about our insurance operations. Growing float at a sizable rate at low cost is almost impossible, but we intend to do it anyway. I've been amazed by the growth and cost of our float. It's wonderful to generate billions of dollars of float at a cost way below Treasury notes. Lumpy results and being willing to write less insurance business if market conditions are unfavorable. That is one of our advantages as an insurer. We don't give a damn about lumpy results. Everyone else is trying to please Wall Street. This is not a small advantage. Nobody else does it, but to me, not worrying about trying to please Wall Street is obviously the only way to go. A lot about Berkshire is like this: being controlling owners is key. It would be hard for a committee to make these kinds of decisions. Berkshire Hathaway repurchasing shares. In the past, when Berkshire had gotten cheap, we have found other even cheapest stocks to buy. I would always preferred this. It's more fun to have the companies so lacking in repute that we can make money for some shareholders by buying out others. Splitting backside stock to create more liquidity. I think the notion that liquidity of tradable common stock is a great contributor to capitalism is mostly twaddle. The liquidity gives as these crazy booms, so it has as many problems as virtues. Buffett, Berkshire trades $50 million of stock per day, so very few people will have a problem selling it. But we're trying to create more people who have the problem of owning stock worth so much that liquidity is an issue. Why don't more companies and investors copy Berkshire Hathaway? It's a good question. Our approach has worked for us. Look at the fun we, our managers, and our shareholders are having. More people should copy us. It's not difficult, but it looks difficult because it's unconventional. It isn't the way things are normally done. We have low overhead, don't have quarterly goals and budgets or a standard personnel system, and our investing is much more concentrated than the average. It's simple and common sense. I was recently speaking with Jack McDonald, who teaches a course on investing rooted in our principles at Stanford Business School. He said it's lonely, like he's the Maytag repairman. Because of great reliability of Maytag products, the appliance repairman becomes the loneliest man in town. Comments on Buffett. It's hard to believe that he's getting better with each passing year. It won't go on forever, but Warren is actually improving. It's remarkable. Most 72-year-old men are not improving, but Warren is. Charlie's influence on Warren. I think those authors give me more credit than I deserve. It is true that Warren had a touch of brain block. From working under Ben Graham and making a ton of money, it's hard to switch from something that's worked so well. But if Charlie Munger had never lived, the Buffett record would still be pretty much what it is. I think there's some mythology in this idea that I've been the great enlightener of Warren. He hasn't needed much enlightenment. But we know more now than 5 years ago. What happens when Buffett's gone? The key is having good businesses. There's a lot of momentum here. However, I don't think our successors will be as good as Warren at capital allocation. Berkshire is drowning in money. We have great businesses pounding out money. If the stock went down, Berkshire could buy it back. There's no reason to think it will go to hell in a bucket, and I think there's reason to believe it could go on quite well. I'd be horrified if it isn't bigger and better over time, even after Warren dies. When Warren is gone, the acquisition side of Berkshire will not do as well, but the rest will do well. And the acquisition side will do just fine. In any case, we've guaranteed you that the historical rate of growth will go down, and we wouldn't want to make a liar out of me. I think the top guy won't be as smart as Warren. But it's silly to complain. What kind of world is this that gives me Warren Buffett for 40 years, and then some bastard comes along who's worse? If anyone would have a reason to worry, it would be me. But having known the Buffett family for decades, I say to you, don't worry about it. You should be so lucky. What if Charlie dies? As you can tell, we're planning on immortality here. What do you need sitting on a pile of money and Warren Buffett sitting at the parent corporation? Charlie as the abominable no man. Buffet, you just have to learn how to calibrate his answers. If you ask Charlie something and he says no, then we put all of our money in it. If he says that's the stupidest thing I've ever heard, then we make a more moderate investment. If you calibrate his answers, you'll get a lot of wisdom. Charlie, the abominable no man. Exchange at a recent Berkshire shareholders meeting. Warren, Charlie, do you have any additional comment? Charlie, no. I think you said ho perfectly. Chuck Rickershauser, former Munger Toll's partner and friend since 1964. Warren told me a story once that, back in the early days of their relationship, when they had no financial connection and each had an investment partnership, Warren would frequently call up Charlie and say, "I'm thinking of doing something," and describe it, and Charlie would say, "My God, are you kidding? There's this risk and that risk." They'd go right through all these risks that Charlie saw, and Warren would usually say, "I think you're right." But once in a while he would say, "Charlie, I've heard everything you said, but I think I'm going to go ahead." Warren said that it wasn't until that instant that he'd learn what Charlie really thought, because occasionally Charlie would respond, "Warren, if you do it, could I have a percentage of it?" People often think of Charlie as identifying risks and saying, "No," but it was his ability to identify the times to ask for a percentage that was most valuable. Otis Booth, friend and business associate since 1956. Charlie realizes that it is difficult to find something is really good. So if you say no 90% of the time, you're not missing much in the world. Investment advice. The importance of temperament, patience, and curiosity. One of the key elements to successful investing is having the right temperament. Most people are too fretful. They worry too much. Success means being very patient, but aggressive when it's time. And the more hard lessons you can learn vicariously rather than through your own hard experience, the better. I think there's something to be said for developing the disposition to own stocks without fretting. But temperament alone won't do it. You need a lot of curiosity for a long, long time. You need to have a passionate interest in why things are happening. That cast of mind, kept over long periods, gradually improves your ability to focus on reality. If you don't have that case of mind, you're destined for failure even if you have a high IQ. Focus investing. Our investment style has been given a name, focus investing, which implies 10 holdings, not 100 or 400. The idea that it is hard to find good investments, so concentrate in a few, seems to me to be an obviously good idea. But 98% of the investment world doesn't think this way. It's been good for us and you that we've done this. What's funny is that most big investment organizations don't think like this. They hire lots of people, evaluate Merck V's, Pfizer, and every stock in the S&P 500, and think they can beat the market. You can't do it. Our game is to recognize a business idea when it comes along. When one doesn't come along very often, opportunity comes to the prepared mind. We have this investment discipline of waiting for a fat pitch. If I was offered the chance to go into a business where people would measure me against benchmarks, force me to be fully invested, crawl around looking over my shoulder, etc. I would hate it. I would regard it as putting me into shackles. Very few people have adopted our approach. Focus investing is growing somewhat, but what's really growing is the unlimited use of consultants to advise on asset allocation, to analyze other consultants, and so forth. Maybe 2% of people will come into our corner of the tent, and the rest of the 98% will believe what they've been told, e.g. that markets are totally efficient. Misteaching investing. Beta and modern portfolio theory, and the like, none of it makes any sense to me. We're trying to buy businesses with sustainable competitive advantages at a low, or even a fair, price. How can professors spread this nonsense that a stock's volatility is a measure of risk? I've been waiting for this craziness to end for decades. It's been dented, but it's still out there. Warren once said to me, "I'm probably misjudging academia generally in thinking so poorly of it, because the people that interact with me have bonkers theories." Diversification. The idea of excessive diversification is madness. We don't believe that widespread diversification will yield a good result. We believe almost all good investments will involve relatively low diversification. If you to cover top 15 decisions out, we would have a pretty average record. It wasn't hyperactivity, but help of a lot of patience used truck to your principles. And when opportunities come along, you pounced on them with vigor. Sit on your ass investing. If you buy something because it's undervalued, then you have to think about selling it when it approaches your calculation of its intrinsic value. That's hard. But if you buy a few great companies, then you can sit on your ass. That's a good thing. We are partial to putting out large amounts of money when we don't have to make another decision. What is the better business? There are two kinds of businesses, the first and 12%, and you can take the profits out at the end of the year, second and 12%. But on the excess cash must be reinvested. There's never any cash. It reminds me of the guy who sells construction equipment. He looks at his used machines taken in as customers bought new ones and says, "There's all of my profit rusting in my yard." We hate that kind of business. See's Candy, case study of a better business. If See's Candy, when we were buying it, had asked for $100,000 more, Buffett chimed in, $10,000 more, Warren and I would have walked, and that's how dumb we were. Ira Marshall said, "You guys are crazy. There are some things you should pay up for, like quality businesses and people. You are underestimating quality." We listened to the criticism and changed our mind. This is a good lesson for anyone, the ability to take criticism constructively and learn from it. If you take the indirect lessons we learned from See's, you could say Berkshire was built on constructive criticism. Mistakes. The most extreme mistakes in Berkshire's history have been mistakes of omission. We saw it but didn't act on it. They're huge mistake. We've lost billions. And we keep doing it. We're getting better at it. We never get over it. There are two types of mistakes. One, doing nothing that Warren calls sucking my thumb, and two, buying with an eyedropper, things we should be buying a lot of. After nearly making a terrible mistake not buying See's, we've made similar mistakes many times. We are apparently slow learners. These opportunity costs don't show up on financial statements, but have cost us many billions. Since mistakes of omission aren't visible, most people don't pay attention to them. We rub our noses in mistakes of omission, as we just did. They had just discussed failing to buy Walmart stock because it moved up a bit, a $10 billion mistake. Buying into stock declines. Over many decades, our usual practice is that if the stock of something we like goes down, we buy more and more. Sometimes something happens, you realize you're wrong and you get out. But if you develop correct confidence in your judgment, buy more and take advantage of stock prices. Attractive investment opportunities tend to be ephemeral. Really good investment opportunities aren't going to come along too often and won't last too long, so you've got to be ready to act. Have a prepared mind. Opportunities for small investors. If you have only a little capital and are young today, there are fewer opportunities than when I was young. Back then, we had just come out of a depression. Capitalism was a bad word. There had been abuses in the 1920s. A joke going around then as the guy who said, "I bought stock for my old age and it worked in 6 months, I feel like an old man." It's tougher for you, but that doesn't mean you won't do well. It just may take more time. But what the heck? You may live longer. I'd work with very small stocks, searching for unusual mispriced opportunities, but it's such a small world. Short selling. Being short and seeing a promoter take the stock up is very irritating. It's not worth it to have that much irritation in your life. Moats and sustainable competitive advantage. Old moats are getting filed in and new moats are harder to predict, so it's getting hardened. Learning process. I don't know anyone who learned to be a great investor with great rapidity. Warren has got to be one hell of a lot better investor over the period I've known him, as have I, so the game is to keep learning. You gotta like the learning process. I've watched Warren for decades. Warren has learned a lot, which has allowed him to expand his circle of competence so he could invest in something like PetroChina. If you're going to be an investor, you're going to make some investments where you don't have all the experience you need. But if you keep trying to get a little better over time, you'll start to make investments that are virtually certain to have a good outcome. The keys are discipline, hard work, and practice. It's like playing golf, you have to work on it. If you don't keep learning, other people will pass you by. Circle of competence and its boundaries. There are a lot of things we pass on. We have 3 baskets, in, our, and too tough. We have to have a special insight, or we'll put it in the too tough basket. All you have to look for is a special area of competency and focus on that. If you have competence, you know the edge. It wouldn't be a competence if you didn't know where the boundaries lie. Asking whether you've passed the boundary is a question that almost answers itself. Cost of capital and opportunity costs. Buffett, Charlie, and I don't know our cost of capital. It's taught at business schools, but we're skeptical. We just look to do the most intelligent thing we can with the capital that we have. We measure everything against our alternatives. I've never seen a cost of capital calculation that made sense to me. Have you, Charlie? Never. If you take the best text in economics by Mankiw, he says intelligent people make decisions based on opportunity costs. In other words, it's your alternatives that matter. That's how we make all of our decisions. The rest of the world has gone off on some kick theirs, even a cost of equity capital. A perfectly amazing mental malfunction. Obviously, consideration of costs is key, including opportunity costs. Of course, capital isn't free. It's easy to figure out your cost of borrowing, but theorists went bonkers on the cost of equity capital. They say that if you're generating a 100% return on capital, then you shouldn't invest in something that generates an 80% return on capital. It's crazy. Value of forecasts. People have always had this craving to have someone tell them the future. Long ago, kings would hire people to read sheep guts. There's always been a market for people who pretend to know the future. Listening to today's forecasters is just as crazy as when the king hired the guy to look at the sheep guts. It happens over and over and over. IPOs. It is entirely possible that you could use our mental models to find good IPOs to buy. There are countless IPOs every year, and I'm sure that there are a few cinches that you could jump on. But the average person is going to get creamed. So if you think you're talented, good luck. IPOs are too small for us or too high-tech, we won't understand them. So if Warren's looking at them, I don't know about it. Comments on the market. Stocks, Rembrandts, and bubbles. Stocks are valued partly like bonds, based on roughly rational projections of producing future cash. But they are also valued partly like Rembrandt paintings, purchased mostly because their prices have gone up so far. This situation, combined with big wealth effects, at first up and later down, can conceivably produce much mischief. April 2000. It's the most extreme in modern capitalism. In the 1930s, we had the worst depression in 600 years. Today is almost as extreme in the opposite way. We use the phrase wretched excess because the consequences are wretched. Bonds are much more rational. No one thinks a bond's value will soar to the moon. Future market returns. November 2000. If stocks compound at 15% going forward, then it will be due to a big Rembrandt effect. This is not good. Look at what happened in Japan, where stocks traded at 50 to 60 times earnings. This led to a 10-year depression. I think that was a special situation, though. My guess is that we won't get extreme Rembrandtization, and the returns thereafter will be 6%. If I'm wrong, it could be for a bad reason. If stocks trade more like Rembrandts in the future, then stocks will rise, but they will have no anchors. In this case, it's hard to predict how far, how high, and how long it will last. April 2001. I think generally that American investors should reduce their expectations. People aren't being a little stupid, but massively stupid. No one has an interest in saying this, though. May 2001. We are nor in a hog heaven period. The investment game is getting more and more competitive. I don't know if we'll ever see stocks in general at the mouth-watering levels that we saw in 1973-74 or even TN 1982. I think there's a very excellent chance that neither Warren or I will see those opportunities again, but that's not all bad. We'll just keep plugging away. Buffett, it's not out of the realm of possibility, though. You can never predict what markets will do. In Japan, a 10-year bond is yielding 0.5%. Who could have ever imagined that? If that could happen in Japan, something much less bad could happen in the US. We could be in for a period in which the average fancy-paid investment advisor just can't do very well. Current outlook. May 2004. In terms of the general climate, I think it's pretty miserable for anyone who likes easy, sure money. Common stocks may be reasonably fairly valued, but they are not overwhelming bargains. Our cash is speaking for itself. If we had a lot of wonderful ideas, we wouldn't have so much cash. Berkshire and Wesco are full of cash that we don't know what to do with. Berkshire has $70 billion if you count the bonds, and Wesco is drowning in cash. It's the most extreme it's ever been. In the past, we've just been patient, and we were able to put it to work. Nothing to add. Number 2. We continue with the question of how Charlie monitors broad economic trends and changes. Question: what macro statistics do you regularly monitor or find useful in your attempt to understand the broader economic landscape? Answer: none. I find by staying abreast of our Berkshire subsidiaries and by regularly reading business newspapers and magazines, I am exposed to an enormous amount of material at the micro level. I find that what I see going on there pretty much informs me about what's happening at the macro level. Critique on corporate management. Earnings manipulation and accounting shenanigans. With so much money riding on reported numbers, human nature is to manipulate them. And with so many doing it, you get Serpico effects, where everyone rationalizes that it's okay because everyone else is doing it. It is always thus. Now it's chain letter mechanics. Because it's mixed with legitimate activities like venture capital, it looks respectable. But we're mixing respectable activity with disrespectable activity. Hence my comment at the Berkshire Hathaway annual meeting about if you mix raisins with turds, you've still got turds. There is nothing in accounting that can prevent unscrupulous managers from engaging in a chain letter type fraud. Spotting crooked managements. Bernie Ebbers and Ken Lay were caricatures. They were easy to spot. They were almost psychopaths. But it's much harder to spot problems at companies like Royal Dutch Shell. But we don't learn because I'd still expect that Exxon's figures are fair. I want to make an apology. Last night, referring to some of our modern business tycoons, I said that when they're talking, they're lying, and when they're quiet, they're stealing. This wasn't my witticism. It was used long ago to describe the robber barons. Corporate America's addiction to extraordinary charges. If it happens every year like clockwork, what's so extraordinary about it? Corporate governance. The cause of reform is hurt not helped. When an activist makes an idiotic suggestion like saying that having Warren on the board of Coke is contrary to the interests of Coke. Nutty behavior undermines their cause. Critique of the money management business. Flawed incentives. The general systems of money management today require people to pretend to do something they can't do and like something they don't. It's a terrible way to spend your life, but it's very well paid. No value added. Mutual funds charge 2% per year, and then brokers switch people between funds, costing another 3 to 4 percentage points. The poor guy in the general public is getting a terrible product from the professionals. I think it's disgusting. It's much better to be part of a system that delivers value to the people who try the product. But if it makes money, we tend to do it in this country. It's a funny business because, on a net basis, the whole investment management business together gives no value added to all buyers combined. That's the way it has to work. Stockbrokers versus index funds. It's hard to sit here at this annual meeting, surrounded by smart, honorable stockbrokers who do well for their clients, and criticize them. But stockbrokers in total will do so poor that the index fund will do better. I think indexing is a user choice for the average foundation than what it is now doing in unleveraged equity investment, and particularly so as its present total croupier costs exceed 1% of principal per annum. Indexing can't work well forever if almost everybody turns to it. But it will work all right for a long time. The mutual fund scandal. The business of selecting investment managers was recently shown to be even harder by the revelation that a significant fraction of mutual fund managers took bribes to betray their own shareholders. It was as if a man came up and said, "Why don't we kill your mother and we'll split the insurance money?" And many people said, "Why, yes, I'd like some of that insurance money." And many of them think what happened to them was unjust. Critique of Wall Street. Wall Street's lack of ethics. The ethics of Wall Street will always average out to mediocre at best. This doesn't mean there aren't some wonderful, intelligent people on Wall Street. There are, like those in this room, but everyone I know has to fight his own firm to do the right thing. The general culture of investment banking has deteriorated over the years. We did a $6 million deal years ago for diversified retailing, and we were rigorously and intelligently screened. The bankers cared and wanted to protect their clients. The culture now is that anything that can be sold for a profit will be. Can you sell it? Is the moral test, and that's not an adequate test. 132. Solomon Case Study. It's amazing what goes on. Solomon was at least disciplined and rational as other investment banks. But by the end, Solomon was begging for investment business from Robert Maxwell, whose nickname was the bouncing check. You would think if this was his nickname, investment banks wouldn't purchasing his business. Buffet. The day they found him bobbing in the water, he committed suicide as this candle about his misdeeds. We Solomon sent to him in exchange for money he was sending to us, but he didn't pay. So we went to England to collect his sons, and it was a mess. We got what we deserved. Editor's note: unlike most creditors, Solomon did eventually get paid as Charlie Puth shit. It was a minor miracle. We didn't deserve to get it back. An investment banker earning would be increased in a significant way if he wrote a few more tickets to Maxwell. You have to control this if guys can make money by bringing dubious things in the door. Normandy, America Case Study. Warren and Charlie chuckled to themselves as they recalled Solomon doing business with another shady character they didn't name. At the 2002 annual meeting, however, Charlie identified the company as Normandy America Inc., whose IPO Solomon had to pull before money exchanged hands when they discovered the promoter had completely manufactured his record. According to a report on the SEC's website, Normandy's stock commenced trading on the NASDAQ National Market System on August 15, 1995. One day later, Normandy withdrew its offering from the market and rescinded all trades. That was a wonderful experience, dripping with sarcasm. Warren, Lou Simpson, and I were all on the board of Solomon. We were the largest shareholders, and we said, "Don't do business with this guy." But they ignored us and said that the underwriting committee had approved it. Buffett, he had a neon sign on him saying "crook." He did go to jail. Incidentally, he claimed to have owned a lot of Berkshire stock and to have made a lot of money on it, but I checked the shareholder records and couldn't see it. It could have been in street name, but for a block that big, I think I would have found it, so he was probably lying about his Berkshire holdings. Critique of accountants. Demise of ethics among the major accounting firms. When I was younger, the major accounting firms were quite ethical places, and nobody got filthy rich. But in the space of 25 years, they sold out to terrible behavior, one little step at a time. Once you start doing something bad, then it's easy to take the next step, and in the end, you're a moral sewer. The idea that the major accounting firms of the country would sell obviously fraudulent tax shelters. Too many law and accounting firms get roped into shady things. For example, tax shelters with their contingency fees and secrecy are a total abomination. You'll better understand the evil of top audit firms starting to sell fraudulent tax shelters when I tell you that one told me that they're better than the others, because they only sold the schemes to their top 20 clients, so no one would notice. Aggressive accounting. We're so horrified by aggressive accounting that is rampant in corporate America that we reach for ways to be conservative. It helps our business decisions and protects Berkshire. How did we get in situations where we're all so close to the line? Creative accounting is an absolute curse to a civilization. One could argue that double-entry bookkeeping was one of history's great advances. Using accounting for fraud and folly is a disgrace. In a democracy, it often takes a scandal to trigger reform. Enron was the most obvious example of a business culture gone wrong in a long, long time. Misuse of EBITDA. I think that, Every time you see the word EBITDA earnings before interest, taxes, depreciation, and amortization, you should substitute the words bullshit earnings. Yes. Arthur Andersen. Yes. I regard what happened to the innocent employees of Arthur Andersen as very unfair, but capitalism without failure is like religion without hell. When it gets this bad and there's a lack of systems for control, which Arthur Andersen didn't have, maybe a firm should just go down. We couldn't do anything that would bring down Berkshire. Arthur Andersen was particularly vulnerable because it was a partnership. A partnership must be extra careful in its behavior, choosing clients, etc. The scandal of American pension fund accounting. The current practice of using unrealistically high assumptions for pension plan returns is a dumb and improper way to handle things. But if you talk to management, their eyes glaze over even before hostility comes. Pension fund accounting is drifting into scandal by using unrealistic assumptions. It's human nature to extrapolate the recent past into the future, but it is terrible that management go along with it. IBM just raised its return expectations for its pension fund to 10%. Year 2000, most companies are at 9%. We think 6% is more realistic. Company leaders may believe it, they're honest people, but subconsciously they believe it because they want to believe it. It makes earnings good so they can promote the stock. The reason accountants don't say anything is best summed up by the saying, "Whose bread I eat at, his song I sing." I think you're getting very foolish numbers in American accounting. I don't think it's willful dishonesty, but it might as well be. Bad accounting leads to immorality. People who have loose accounting standards are just inviting perfectly horrible behavior in other people. And it's a sin, it's an absolute sin. If you carry bushel baskets full of money through the ghetto and made it easy to steal, that would be a considerable human sin because you'd be causing a lot of bad behavior, and the bad behavior would spread. Similarly, an institution that uses sloppy accounting commits a real human sin, and it's also a dumb way to do business. Critique of stock options. Stock options as compensation. If you look at the impact of stock options, you'll see a lot of terrible behavior. To give a lot of options to a CEO who built the business and is in his 60s, to incent loyalty, is demented. Would the doctors at the Mayo Clinic or the lawyers at Kraveth, who are in their 60s, work harder if they had options? As our shareholders know, our system is different from most big corporations. We think it's less capricious. The stock option system may give extraordinary rewards to some people who did nothing, and give nothing to those who deserve a lot. Except where we inherited a stock option program, we don't use it. Valuing options and the Black-Scholes model. Black-Scholes works for short-term options, but if it's a long-term option and you think you know something about the underlying asset, it's insane to use Black-Scholes. Black-Scholes is a know-nothing system. If you know nothing about value-only price, then Black-Scholes is a pretty good guess at what a 90-day option might be worth. But the minute you get into longer periods of time, it's crazy to get into Black-Scholes. For example, at Costco, we issued stock options with strike prices of $30 and $60, and Black-Scholes value the $60 ones higher. This is insane. Accounting for stock options. The theory that options have no cost has contributed to a lot of excesses, which is bad for the country because corporate compensation is perceived as unfair. I'm so tired of this subject. I've been on this topic for so long. It's such a rotten way to run a civilization, to make the accounting wrong. It's like getting the engineering wrong when making a bridge. When perfectly reputable people say options shouldn't be expensed, it's outrageous. A stock option is both an expense and dilution. To argue anything else is insane. These people, the 88 senators who voted to maintain the status quo of not expensing stock options, are stupid and dishonorable. They know it was wrong and did it anyway. The only thing that's consistent is that the whole thing is disgusting. I'd rather make my money playing piano in a whorehouse than account for options as recommended by John Doerr. Warnings about financial institutions and derivatives. Risks of financial institutions. The nature of a financial institution is that there are a lot of ways to go to hell in a trucker. You can push credit too far, do a dumb acquisition, leverage yourself excessively. It's not just derivatives that can bring about your downfall. Maybe it's unique to us, but we're quite sensitive to financial risks. Financial institutions make us nervous when they're trying to do well. We are exceptionally goosey of leveraged financial institutions. If they start talking about how good risk management is, it makes us nervous. We fret way earlier than other people. We've left a lot of money on the table through early fretting. It's the way we are, you'll just have to live with it. Derivatives. The system is almost insanely irresponsible. And what people think are fixes aren't really fixes. It's so complicated I can't do it justice here, but you can't believe the trillions of dollars involved. You can't believe the complexity. You can't believe how difficult it is to do the accounting. You can't believe how big the incentives are to have wishful thinking about values and wishful thinking about ability to clear. People don't think about the consequences of the consequences. People start by trying to hedge against interest rate changes, which is very difficult and complicated. Then the hedges make the reported profits lumpy. So then they use new derivatives to smooth this. Well, now you've morphed into lying. This turns into a Mad Hatter's Tea Party. This happens to vast, sophisticated corporations. Somebody has to step in and say, we're not going to do it, it's just too hard. I think a good litmus test of the mental and moral quality at any large institution with significant derivatives exposure would be to ask them, do you really understand your derivatives book? Anyone who says yes is either crazy or lying. It's easy to see the dangers when you talk about what happened with the energy derivatives. They went kerflooey. When the companies reached for the assets that were on their books, the money wasn't there. When it comes to financial assets, we haven't had any such denouement, and the accounting hasn't changed. So the denouement, the final part of a play, movie, or narrative in which the strands of the plot are drawn together and matters are explained or resolved, is ahead of us. Derivatives are full of clauses that say if one party's credit gets downgraded, then it has to put up collateral. It's like margin. You can go broke just putting up more margin. In attempting to protect themselves, they've introduced instability. Nobody seems to recognize what a disaster of a system they've created. It's a demented system. In engineering, people have a big margin of safety. But in the financial world, people don't give a damn about safety. They let it balloon and balloon and balloon. It's aided by false accounting. I'm more pessimistic about this than Warren. Misuse of derivatives. It's a Mad Hatter Tea Party. Take some more tea, the March Hare said to Alice very earnestly. I've had nothing yet, Alice replied in an offended tone, so I can't take more. You mean you can't take less, said the Hatter. It's very easy to take more than nothing. From Lewis Carroll's Alice's Adventures in Wonderland. The Hatter, popularly known as the Mad Hatter, is an enigmatic character encountered at a tea party and later as a trial witness in Lewis Carroll's Alice's Adventures in Wonderland. The real Hatter is generally believed to be Theophilus Carter, inventor of an alarm clock bed, exhibited at the Great Exhibition of 1851, that tipped out the sleeper at waking time. Carter later owned a furniture shop and became known as the Mad Hatter from his habit of standing in the door of his shop wearing a top hat. Sir John Tenniel is reported to have come to Oxford for the express purpose of sketching Carter for one of his Wonderland illustrations. Accounting for derivatives. I hate with a passion GAAP, generally accepted accounting principles, as applied to derivatives and swaps. J.P. Morgan sold out to this type of accounting to front-end revenues. I think it's a disgrace. It's bonkers, and the accountants sold out. Everyone caved, adopted loose accounting standards, and created exotic derivatives linked to theoretical models. As a result, all kinds of earnings blessed by accountants are not really being earned. When you reach for the money, it melts away. It was never there. Accounting for derivatives is just disgusting. It is a sewer, and if I'm right, there will be hell to pay in due course. All of you will have to prepare to deal with a blow-up of derivative books. To say accounting for derivatives in America is a sewer is an insult to so age. Likelihood of a derivatives blow-up. We tried to sell Gen-Ray's derivatives operation and couldn't, so we started liquidating it. We had to take big markdowns. I would confidently predict that most of the derivative books of this country's major banks cannot be liquidated for anything like what they're carried on the books at. When the denouement will happen and how severe it will be, I don't know. But I fear the consequences could be fearsome. I think there are major problems, worse than in the energy field, and look at the destruction there. I'll be amazed if we don't have some kind of significant derivatives-related blow up in the next 5 to 10 years. I think we're the only big corporation in America to be running off its derivative book. It's a crazy idea for people who are already rich like Berkshire to be in this business. It's a crazy business for big banks to be in. You would be disgusted if you had a fair mind and spent a month really delving into a big derivative operation. You would think it was Lewis Carroll, author of Alice's Adventures in Wonderland. You would think it was the Mad Hatter's Tea Party. And the false precision of these people is just unbelievable. They make the worst economics professors look like gods. Moreover, there is depravity augmenting the folly. Read the book FIASCO by law professor and former derivatives trader Frank Partner, an insider account of depravity in derivative trading at one of the biggest and best-regarded Wall Street firms. The book will turn your stomach. Critique of lawyers, law firms, and litigation. Demise of ethics among law firms. I never have the slightest interest in defending miscreants and helping them misbehave. But the general view is that it's wonderful what Johnny Cochran did getting O.J. Simpson off. Lawyers botched the Martha Stewart case. What happened with Martha Stewart was that she heard some news, panicked, and sold the stock. It turns out that if she just told the truth, she'd have been okay. But because she had a vague idea that what she'd done was wrong, she had a totally phony story when the investigators came, and she lied to them, and that's a felony. And she did these acts after she'd hired highfalutin lawyers. And I'm sure they charged her a lot. I do not invent these stories. Were I her lawyer, I would have said, "You know, Martha, that's an interesting story, and I'm your lawyer, so I'm required to believe you, but nobody else will. So you're going to have to come up with a different story, or you'll have to tell it through a different lawyer because I don't like losing cases. And it'll work. It's so simple." Literally, she went to prison for her behavior after she'd hired a lawyer. The tort system. What's particularly pernicious is the increasing political power of the plaintiff's bar. State Supreme Court judges are generally on for life. The only thing that can jeopardize this is for them to really anger some important group like the plaintiff's bar. Thus, the judges allow junk science and the like. Because of the tort system, there are whole areas for the already rich to avoid. For example, a company developed a new, safer, better police helmet, but sold the product to a judgment-proof company because the helmet developer was afraid of liability. It would be crazy for Berkshire to be in the business of providing security guards at airports. The system discourages the best companies from entering certain businesses. Asbestos and tort reform. Asbestos has morphed into a situation with enormous amounts of fraud. People with serious injuries are being hurt as more and more money flows to the plaintiff's bar and to claimants with no current injuries. The Supreme Court has practically invited Congress to step in, but Congress has refused due to the influence of the trial lawyers. I'd be surprised if there's a constructive solution in the next 5 years. I expect there will just be more of the current mess. What's happened in asbestos is that a given group of people get mesothelioma, a horrible cancer that comes only from asbestos exposure and kills people. Then there's another group of claimants who smoke 2 packs of cigarettes a day and have a spot on their lung. Then you get a lawyer who gets a doctor to testify that every spot is caused by asbestos. Once you effectively bribe a doctor, then you can get millions of people to sue on fears of getting cancer. But there's not enough money to pay all of the claimants, so people who are truly harmed don't get enough. In a southern state with a jury pool that hates all big companies, you get big judgments. But lawyers are stealing money from people who are hurt and giving it to people who aren't entitled. It's a bonkers system, but with federalism states' rights, there's no way to stop it. The Supreme Court refused to step in. Trying to buy people off is like trying to put out a fire by dousing it with gasoline. With word processors, lawyers can easily produce countless claimants. But only 25% of the money goes to claimants. The rest goes to the lawyers, doctors, etc. If you want to be cynical, look at the perjury. There are only 3 solvent companies left facing asbestos claims, so plaintiffs can only remember those 3 names when recalling which products they were exposed to decades ago. It's a case of perjury being suborned by practicing lawyers. The only people who can fix it are the Supreme Court or Congress. The Supreme Court, some people would say, rightly refused to get involved, but I say they chickened out, and Congress, given the politics, has yet to step in. There's an important lesson here. Once wrongdoers get rich, they get enormous political power and you can't stop it, so the key is to nip things like this in the bud. It would be easy to fix the problem. The right way is to say, we're not going to pay off all these little claims. The government's lawsuit against Microsoft. April 2000. Someone whose salary is paid by U.S. taxpayers is happy to dramatically weaken the one place where we're winning big. Every business tries to turn this year's success into next year's greater success. It's hard for me to see why Microsoft is sinful to do this. If it's a sin, then I hope all of Berkshire Hathaway subsidiaries are sinners. Mental models. The importance of multiple mental models. You must know the big ideas in the big disciplines and use them routinely, all of them, not just a few. Most people are trained in one model economics, for example, and try to solve all problems in one way. You know the old saying, to the man with a hammer, the world looks like a nail. This is a dumb way of handling problems. You need a different checklist and different mental models for different companies. I can never make it easy by saying, here are 3 things. You have to derive it yourself to ingrain it in your head for the rest of your life. You can't learn those 100 big ideas you really need the way many students do, where you learn 'em well enough to bang 'em back to the professor and get your grade, and then you empty them out as though you were emptying a bathtub so you can take in more water next time. If that's the way you learn the 100 big models you're going to need, you'll be, and also ran in the game of life. You have to learn the models so that they become part of your ever-used repertoire. By the way, there's no rule that you can't add another model or two, even fairly late in life. In fact, I've clearly done that. I got most of the big ones quite early, however. The happier mental realm I recommend is one from which no one willingly returns. A return would be like cutting off one's hands. The ethos of not fooling yourself. It is ridiculous the way a lot of people playing to failed ideas keens. It's not bringing in the new ideas that's so hard, it's getting rid of the old ones. The ethos of not fooling yourself is one of the best you could possibly have. It's powerful because it's so rare. Common and uncommon sense. Organized common or uncommon sense, very basic knowledge, is an enormously powerful tool. There are huge dangers with computers. People calculate too much and think too little. Part of having uncommon sense is being able to tune out folly as opposed to recognizing wisdom. If you bat away many things, you don't clutter yourself. We read a lot. I don't know anyone who's wise who doesn't read a lot. But that's not enough. You have to have a temperament to grab ideas and do sensible things. Most people don't grab the right ideas or don't know what to do with them. The more basic knowledge you have, the less new knowledge you have to get. The guy who plays chess blindfolded, a chessmaster, comes to Omaha during Berkshire's annual meeting. We can add in an exhibition place multiple players blindfolded. He has knowledge of the board, allows them to do this. Henry E. Singleton, 1916-1999. Business and chess master. Singleton was co-founder of Teledyne, Inc. and Chi F, executive of the Los Angeles-based conglomerate, for 3 decades. He attended the Naval Academy, then transferred to MIT, where he received bachelor's, master's, and PhD degrees in electrical engineering. An enormously skilled chess player, he was only 100 points below the grandmaster level and could play without looking at the board. From 1963 to 1990, Glendine returned an astounding 20.4% compound annual return to shareholders, a period in which the S&P 500 returned 8%. Adroitly repurchasing 90% of Teledyne outstanding shares primarily between 1972 and 1984, Singleton built a record as a manager and capital allocator with few peers in modern business history. Sharing Buffett's admiration for Henry E. Singleton, Charlie wonders, given the many talent and record, have we learned enough from him? Henry Singleton has the best operating and capital deployment record in American business. If one took the 100 top business school graduates and made a composite of their triumphs, their record would not be as good as Singleton. Critique of academia. Fatal connectedness. There's a lot wrong with American universities. I'd remove 3/4 of the faculty, everything but the hard sciences. But nobody's going to do that, so we will have to live with the defects. It's amazing how wrong-headed the teaching is. There is fatal disconnected miss. You have these squirrely people in each department who don't see the big picture. I think liberal arts faculty is at major universities have used that are not very sound, at least on public policy issues. However, they may know a lot of French. Whitehead spoke of the cattle and connectedness of academic disciplines, wherein each professor didn't even know the models of the other disciplines, much less try to synthesize those disciplines with his own. I think there is a modern name for this approach that Whitehead did not like, and that name is bonkers. How to be happy, get rich, and other advice. Tip on how to be happy and successful. If all you succeed in doing in life is getting rich by buying little pieces of paper, it's a failed life. Life is more than being shrewd in wealth accumulation. A lot of success in life and business comes from knowing what you want to avoid: early death, a bad marriage, etc. Just avoid things like AIDS situations, racing trains to the crossing, and doing cocaine. Develop good mental habits. Avoid evil, particularly if they're attractive members of the opposite sex. If your new behavior earns a little temporary unpopularity with your peer group, then the hell with them. Be satisfied with what you have. There is one truth that perhaps you, our typical investment counsel, would disagree with if you are comfortable rich, and someone else is getting richer faster than you by, for example, investing in risky stocks. So what someone will always be getting faster than you, this is not a tragedy. Look at Stanley Druckenmiller, who ran one of George Soros' fund, which suffered large losses in speculative tech and biotech stocks. He always had to be the best and couldn't stand that others were beating him by investing in these sectors. Soros couldn't bear to see others make money in the technology sector without him, and he got killed. It doesn't bother us at all that others are making money in the tech sector. Beware of envy. The idea of caring that someone is making money faster than you are is one of the deadly sins. Envy is a really stupid sin, because it's the only one you could never possibly have any fun at. There's a lot of pain and no fun. Why would you want to get on that trolley? How to get rich. A young shareholder asked Charlie how to follow in his footsteps, and Charlie brought down the house by saying, "We get these questions a lot from the enterprising young." It's a very intelligent question. You look at some old guy who's rich and you ask, "How can I become like you, except faster?" Spend each day trying to be a little wiser than you were when you woke up. Discharge your duties faithfully and well. Step by step you get ahead, but not necessarily in fast spurts. But you build discipline by preparing for fast spurts. Slug it out 1 inch at a time, day by day. At the end of the day, if you live long enough, most people get what they deserve. How to find a good spouse. What's the best way to get a good spouse? The best single way is to deserve a good spouse, because a good spouse is by definition not nuts. The importance of reading. In my whole life, I have known no wise people over a broad subject matter area who didn't read all the time. None. Zero. You'd be amazed at how much Warren reads and at how much I read. My children laugh at me. They think I'm a book with a couple of legs sticking out. I am a biography, not myself. And I think when you're trying to teach the great concepts that work, it helps to tie them into the lives and personalities of the people who developed them. I think you learn economics better if you make Adam Smith your friend. That sounds funny, making friends among the eminent dead. But if you go through life making friends with the eminent dead who had the right ideas, I think it will work better in life and work better in education. It's way better than just being given the basic concepts. Reduce material needs. Most people will see declining returns. Defenses, if you're worried about inflation, is not to have a lot of silly needs in your life. You don't need a lot of material goods. Philanthropy. Warren and I feel that those of us who have been very fortunate have a duty to give back. Whether one gives a lot as one goes along, as I do, or a little and then a lot when one dies, as Warren does, is a matter of personal preference. I would hate to have people ask me for money all day long. Warren couldn't stand it. Avoid debt. Once you get into debt, it's hell to get out. Don't let credit card debt carry over. You can't get ahead paying 18%. The decline of public schools. You could argue that the decline of public schools is one of the major disasters in our lifetime. We took one of the greatest successes in the history of the Earth and turned it into one of the greatest disasters in the history of the Earth. Yes. Japan's recession. Yes. Anyone has to be flabbergasted by Japan's recession, which has endured for 10 years, despite interest rates below 1%. The government is playing all the monetary games, but it's not working. If you had described this situation to Harvard economists, they could have said it's impossible. Yet at the same time, there's an asset bubble in Hong Kong. Why? Because Japan and China are two vastly different cultures. The Chinese are gamblers. This is a classic example of why, to be a successful investor, one must drop from many disciplines. Imagine an economist standing up at a meeting of economics and giving my explanation. It wouldn't be politically correct, but the tools of economics don't explain what's going on. Humor. I would rather throw a viper down my shirt front than hire a compensation consultant. When asked at a cocktail party whether he played the piano, Charlie replied, "I don't know, I have never tried." I always like it when someone attractive to me agrees with me, so I have fond memories of Phil Fisher. It is of course normal for self-appraisal to be more positive than external appraisal. Indeed, a problem of this sort may have given you your speaker today. In the corporate world, if you have analysts, due diligence, and no horse sense, you have just described hell. It's been so long since we've bought anything that asking us about our market impact when we're trading is like asking Rip Van Winkle about the past 20 years. When I first moved to California, there was a part-time legislature that was controlled by gambling interests, race track owners, and liquor distributors, who wined and dined the legislators, supplied them with prostitutes, etc. I think I prefer that to today's full-time legislature. On the book Deep Simplicity, it's pretty hard to understand everything, but if you can't understand it, you can always give it to a more intelligent friend. If you rise in life, you have to behave in a certain way. You can go to a strip club if you're a beer-swilling sand shoveler, but if you're the Bishop of Boston, you shouldn't go. I think the people who are attracted to be prison guards are not nature's noblemen to begin with. You don't want to be like the motion picture executive who had many people at his funeral, but they were there just to make sure he was dead. Or how about the guy who, at his funeral, the priest said, "Won't anyone stand up and say anything nice about the deceased?" And finally someone said, "Well, his brother was worse." Responding to a question at the 1999 Berkshire Hathaway annual meeting about the year 2000 compliance issue, Munger replied, "I find it interesting that there is such a problem. You know, it was predictable that the year 2000 would come. When you mix raisins and turns, you have still got aides comparing the benefits that the internet and technology are providing to society versus the evils of stock speculation in these sectors." Ben Franklin was a very good and best, and whatever was wrong with him from John Adams' point of view, I am sure, helped him with the French. 158. Simpson on Munger. When I first met Charlie Munger, I knew he was a unique individual, but I didn't realize just how unique until I knew him better. I have now known Charlie for 25 years and have had the opportunity to observe him under a wide range of circumstances, including the aftermath of the Salomon bond crisis of the early 90s, where we were both serving on the board of directors. I can attest that Charlie has a combination of characteristics that I have never seen in any other single individual. He has an extraordinary and deep intelligence across a broad range of interests, and he never seems to forget anything, no matter how arcane or trivial. On top of these attributes is his absolute commitment to honesty, ethics, and integrity. Charlie never grabs for himself and can be trusted without reservation. If that's not enough, he has a temperament coward investing that can only be described as ideal. Unyielding patience, discipline, and self-control. Charlie just doesn't crack or compromise on his principles, no matter how stressful the situation. How fortunate we have all been to have this duo of Charlie Munger and Warren Buffett as our partners, teachers, and role models for all these years. These are truly exceptional men. Munger on Simpson. Lou Simpson is a highly intelligent and honorable man. I was pleased that in the annual letter to shareholders this year, 2005, Warren printed Lou's 25-year investment track record. It's not unheard of to beat the market averages for a couple of years, maybe even 5 or 10 years. But imagine beating the S&P 500 by an average annual gain of 6.8% over 25 years. This extraordinary track record speaks for itself. Lou has one of the greatest investment minds of our time. He is, as Warren says, a shoo-in for the Investment Hall of Fame. I remember well the dot-com boom of the late 90s and how Lou handled it. You can't believe the pressure that he was under, year after year, as the world seemed to be reaping enormous gains while he, correctly, avoided the bubble altogether, staying true to fundamentals. Lou was a wonderful example in that period, intelligent, honorable, and true to his fundamentals. Single on Munger. I had the pleasure of meeting Charlie 8 years ago when he agreed to have lunch with me in Los Angeles at the California Club. My purpose was to convince him to consider joining the Costco board of directors. I liked him from the moment we met when he told me how much he enjoyed shopping at Costco, and despite our being interrupted continuously by the other 500-plus people dining there that day, who all felt compelled to say hello to Charlie, and whom Charlie identified by name in almost every instance, we managed to have a great conversation. First off, Charlie was astute enough to recognize what a great value Costco membership represented. Later, of course, I learned of Charlie's reputation for thriftiness, which clarified Costco's appeal, but more importantly, his straightforwardness and common-sense business acumen came through loud and clear. Later, when he called to accept the position on the board, he referred to himself as a septuagenarian. Pretty fancy description to share with someone from the warehouse industry. I was flattered he thought I understood him. Since then, he has provided everything that can be expected from a director. His insight, questioning, and support have made Costco a better governed and better operated company. As an extra bonus, we are treated to regular doses of the Munger wit. We are lucky people. Munger on Single. You just wouldn't believe how efficient and sophisticated Costco's warehouse operation is. Jim Single is a fabulous business operator like a Carnegie, Rockefeller, or James J. Hill. I consider him to be one of the top 5 retailers of the past century. He's that good. He works 80 hours a week and sets a terrific example for his entire organization in terms of work ethic, integrity, loyalty, and selflessness. He's a moral leader as well as a practical leader. These are not minor virtues. We have our own living, breathing Sam Walton at Costco. Chapter 4:11 Talks. Charlie Munger is not the least bit shy when it comes to offering both frank criticism and constructive advice. When he sets his sights on an issue, be it a corrupt business practice, an academic failing, or a financial scandal, he lets loose with both barrels. Which is not to say he spends all his time focused on life's failings. He is equally at home discussing the values of lifelong learning or the joys of a successful marriage. But whatever the topic, Charlie is apt to tell it like it is, which is exactly what he has done in over 2 decades of public speaking. Here then are 11 of Charlie's best talks, including a special compilation he has prepared exclusively for this book. Enjoy. In a vow that students the world over may hope he renounces, Charlie delivered the one and only graduation speech I will ever make in 1986 at the Harvard School in Los Angeles. The occasion was the graduation of Philip Munger, the last of 5 Munger family sons to matriculate at this prep school, originally an all-boys institution, and now the co-educational school called Harvard Westlake. Despite Charlie's self-effacing protestations about then lacking significant public speaking experience, he demonstrates imposing rhetorical talents in this short speech. We also get a good taste of both Charlie's value system and wit. Most graduation speakers choose to lay out a prescription for attaining a happy life. Charlie, using the inversion principle he recommends in the speech, compellingly makes the opposite case by setting forth what a graduate may do to reach a state of misery. For those of you who want to remain unenlightened and mirthless, do not, under any circumstances, read this selection. Harvard School Commencement Speech, June 13, 1986. Now that Headmaster Beresford has selected one of the oldest and longest-serving trustees to make a commencement speech, it behooves the speaker to address 2 questions in every mind. 1. Why was such a selection made? 2. How long is the speech going to last? I will answer the first question from long experience alongside Beresford. He is seeking enhanced reputation for our school in the manner of the man who proudly displays his horse that can count to 7. The man knows that counting to 7 is not much of a mathematical feat, but he expects approval. Because doing so is creditable, considering the performer is a horse. The second question, regarding the length of the speech, I am not going to answer in advance. It world deprive your upturned faces of lively curiosity and obvious keen anticipation, which I prefer to remain, regardless of source. But I will tell you how my consideration of speech length created the subject matter of the speech itself. I was puffed up when invited to speak. While not having significant public speaking experience, I do hold a black belt in chutzpah, and I immediately considered Demosthenes and Cicero as role models, and anticipated trying to earn a compliment like Cicero gave when asked which was his favorite among the orations of Demosthenes. Cicero replied, "The longest one." However, fortunately for this audience, I also thought of Samuel Johnson's famous comment when he addressed Milton's poem Paradise Lost and correctly said, "No one ever wished it longer." And that made me consider which of all the 20 Harvard School graduation speeches I had heard that I had wished longer. There was only one such speech, given by Johnny Carson, specifying Carson's prescriptions for guaranteed misery in life. I therefore decided to repeat Carson's speech, but in expanded form with some added prescriptions of my own. After all, I am much older than Carson was when he spoke and have failed and been miserable more often, and in more ways than was possible for a charming humorist speaking at a younger age. I am plainly well qualified to expand on Carson's theme. Marcus Tullius Cicero. A poet, philosopher, rhetorician, and humorist, Cicero was also one of Rome's great orators. Cicero viewed public service to be a Roman citizen's highest duty. He defended those unjustly accused by dictatorial leaders and brought down corrupt governments. Late in life, he led the Senate's unsuccessful battle against Antony, for which he paid with his life in 43 BC. What Carson said was that he couldn't tell the graduating class how to be happy, but he could tell them from personal experience how to guarantee misery. Carson's prescription for sure misery included ingesting chemicals in an effort to alter mood or perception. 2. Envy and 3. Resentment. I can still recall Carson's absolute conviction as he told how he had tried these things on occasion after occasion and had become miserable every time. It is easy to understand Carson's first prescription for misery-ingesting chemicals. I add my voice. The four closest friends of my youth were highly intelligent, ethical, humorous types, favored in person and background. Two are long dead, with alcohol a contributing factor, and a third is a living alcoholic, if you call that living. Yep. Carson said he couldn't tell the graduating class how to be happy, but he could tell them from personal experience how to guarantee misery. Yep. While susceptibility varies, addiction can happen to any of us through a subtle process where the bonds of degradation are too light to be felt until they are too strong to be broken. And yet, I have yet to meet anyone in over 6 decades of life whose life was worsened by fear and avoidance of such a deceptive pathway to destruction. Envy, of course, joins chemicals in winning some sort of quantity prize for causing misery. It was wreaking havoc long before it got a bad press in the laws of Moses. If you wish to retain the contribution of envy to misery, I recommend that you never read any of the biographies of that good Christian, Samuel Johnson, because his life demonstrates in an enticing way the possibility and advantage of transcending envy. Yet, resentment has always worked for me exactly as it worked for Carson. I cannot recommend it highly enough to you if you desire misery. Johnson spoke well when he said that life is hard enough to swallow without squeezing in the bitter rind of resentment. For those of you who want misery, I also recommend refraining from practice of the Disraeli compromise, designed for people who find it impossible to quit resentment cold turkey. Disraeli, as he rose to become one of the greatest prime ministers, learned to give up vengeance as a motivation for action, but he did retain some outlet for resentment by putting the names of people who wronged him on pieces of paper in a drawer. Then, from time to time, he reviewed these names and took pleasure in noting the way the world had taken his enemies down without his assistance. Johnson spoke well when he said that life is hard enough to swallow without squeezing in the bitter rind of resentment. One of the greatest poets of the English language, John Milton was best known for his epic poem Paradise Lost, 1667. His powerful prose and the eloquence of his poetry had an immense influence, especially on 18th-century verse. Milton also published pamphlets defending civil and religious rights. To Samuel Johnson's point about Milton's long-windedness, Paradise Lost runs to 12 books and thousands of lines. Addiction can happen to any of us through a subtle process where the bonds of degradation are too light to be felt until when they are too strong to be broken. Well, so much for Carson's 3 prescriptions. Here are 4 more prescriptions from Munger. First, be unreliable. Do not faithfully do what you have engaged to do. If you will only master this one habit, you will more than counterbalance the combined effect of all your virtues, howsoever great. If you like being distrusted and excluded from the best human contribution and company, this prescription is for you. Master this one habit, and you will always play the role of the hare in the fable, except that instead of being outrun by one fine turtles, you will be outturned by hordes and hordes of mediocre turtles, and even some mediocre turtles on crutches. I must warn you that if you don't follow my first prescription, it may be hard to end up miserable, even if you start disadvantaged. I had a roommate in college who was and is severely dyslexic, but he is perhaps the most reliable man I have ever known. He has had a wonderful life so far, outstanding wife and children, chief executive of a multi-billion-dollar corporation. If you want to avoid a conventional, main culture, establishment result of this kind, you simply can't count on your other handicaps to hold you back if you persist in being reliable. I cannot here pass by reference to a life described as wonderful sofa without reinforcing the sofa aspects of the human condition by repeating the remarks of Chorasus, once the richest king in the world, later in ignominious captivity, as you prepared to be burnt alive. He said, "Well, now do I remember the words of the historian in Ceylon. No man's life should be accounted a happy one until it's over." Yep. My second prescription for misery is to learn everything you possibly can from your own experiences, minimizing what you learn vicariously from the good and bad experience of others, living and dead. This prescription is a sure-shot producer CF misery and second-rate achievement. You can see the results of not learning from others' mistakes by simply looking about you how little originality there is in the common disasters of mankind: drunk driving deaths, reckless driving, mammimings, incurable venereal diseases, conversion of bright college students into brainwashed zombies as members of destructive cults, business failures through repetition of obvious mistakes made by predecessors, various forms of crowd folly, and so on. I recommend as a memory clue to finding the way to real trouble from heedless, unoriginal error the modern saying, "If at first you don't succeed, well, so much for hang gliding." Yep. The other aspect of avoiding vicarious wisdom is the rule for not learning from the best work done before yours. The prescription is to become as non-educated as you reasonably can. Yep. Perhaps you will better see the type of non-miserable result you can thus avoid if I render a short historical account. There once was a man who assiduously mastered the work of his best predecessors, despite a poor start and very tough time in analytical geometry. Eventually, his own work attracted wide attention, and he said of his work, "If I have seen a little farther than other men, it is because I stood on the shoulders of giants." The bones of that man lie buried now in Westminster Abbey under an unusual inscription. Here lie the remains of all that was mortal in Sir Isaac Newton. Franklin on vicarious learning. If you will not hear reason, she will surely rap your knuckles. They that won't be counseled can't be helped. Experience keeps a dear school, but fools will learn in no other, and scarce in that. For it is true, we may give advice, but we cannot give conduct. Sir Isaac Newton, 1642–1727. At birth in Lincolnshire, England, Newton was so tiny and frail that he was not expected to live. Yet he lived into his 80s. During his young adulthood, Newton made tremendous discoveries in general mathematics, algebra, geometry, calculus, optics, and celestial mechanics. Most famous among these discoveries was his description of gravity. The publication of his book, The Mathematical Principles of Natural Philosophy, in 1687, marked the peak of Newton's creative career. My third prescription to you for misery is to go down and stay down when you get your first, second, or third severe reverse in the battle of life. Because there is so much adversity out there, even for the lucky and wise, this will guarantee that, in due course, you will be permanently mired in misery. Ignore at all costs the lesson contained in the accurate epitaph written for himself by Epictetus. Here lies Epictetus, a slave, maimed in body, the ultimate in poverty, and favored by the gods. Invert always invert, Jacobi said. He knew that it is in the nature of things that many hard problems are best solved when they are addressed backward. My final prescription to you for a life of fuzzy thinking and infelicity is to ignore a story they told me when I was very young about a rustic who said, "I wish I knew where I was going to die, and then I'd never go there." Most people smile, as you did, at the rustic's ignorance and ignore his basic wisdom. If my experience is any guide, the rustic's approach is to be avoided at all cost by someone bent on misery. To help fail, you should discount as mere quirk, with no useful message, the method of the rustic, which is the same one used in Carson's speech. What Carson did was to approach the study of how to create X by turning the question backward, that is, by studying how to create non-X. The great algebraist Jacobi had exactly the same approach as Carson and was known for his constant repetition of one phrase: invert, always invert. It is in the nature of things, as Jacobi knew, that many hard problems are best solved only when they are addressed backward. For instance, when almost everyone else was trying to revise the electromagnetic laws of Maxwell to be consistent with the motion laws of Newton, Einstein discovered special relativity as he made a 180-degree turn and revised Newton's laws to fit Maxwell's. It is my opinion, as a certified biography nut, that Charles Robert Darwin would have ranked near the middle of the Harvard School graduating class of 1986. Yet he is now famous in the history of science. This is precisely the type of example you should learn nothing from if bent on minimizing your results from your own endowment. Darwin's result was due in large measure to his working method, which violated all my rules for misery, and particularly emphasized a backward twist in that he always gave priority attention to evidence tending to disconfirm whatever cherished and hard-won theory he already had. In contrast, most people early achieve and later intensify a tendency to process new and disconfirming information, so that any original conclusion remains intact. They become people of whom Philip Wiley observed, "You couldn't squeeze a dime between what they already know and what they will never learn." The life of Darwin demonstrates how a turtle may outrun the hares, aided by extreme objectivity, which helps the objective person end up like the only player without a blindfold in a game of pin the tail on the donkey. The life of Darwin demonstrates how a turtle may outrun the hares, aided by extreme objectivity, which helps the objective person end up like the only player without a blindfold in a game of pin the tail on the donkey. If you minimize objectivity, you ignore not only a lesson from Darwin but also one from Einstein. Einstein said that his successful theories came from curiosity, concentration, perseverance, and self-criticism. And by self-criticism, he meant the testing and destruction of his own well-loved ideas. Finally, minimizing objectivity will help you lessen the compromises and burden of owning worldly goods, because objectivity does not work only for great physicists and biologists. It also adds power to the work of a plumbing contractor in Bemidji. Therefore, if you interpret being true to yourself as requiring that you retain every notion of your youth, you will be safely underway, not only toward maximizing ignorance, but also toward whatever misery can be obtained through unpleasant experiences in business. It is hitting that a backward sort of speech end with a backward sort of toast, inspired by Elihu Root's repeated accounts of how the dog went to Dover, leg over leg. To the class of 1986, gentlemen, may each of you rise by spending each day of a long life aiming low. Johnny John William Carson, 1925-2005. Born in Corning, Iowa, Johnny Carson became famous as America's late-night king of comedy. He had a popular radio show in Omaha for years and claimed the city as his hometown. For 30 years, from 1962 to 1992, he entertained millions as host of NBC Television's The Tonight Show. His show featured thousands of authors, filmmakers, actors, singers, and stand-up comedians, of course, many of whose careers he launched. Talk 1 Revisited. As I review in 2006 this talk made in 1986, I would not revise a single idea. If anything, I now believe even more strongly that 1. Reliability is essential for progress in life, and 2. While quantum mechanics is unlearnable for a vast majority, reliability can be learned to great advantage by almost anyone. Indeed, I have often made myself unpopular on elite college campuses, pushing this reliability theme. What I say is that McDonald's is one of our most admirable institutions. Then, as signs of shock come to surrounding faces, I explain that McDonald's, providing first jobs to millions of teenagers, many troubled over the years, has successfully taught most of them the one lesson they most need: to show up reliably for responsible work. Then I usually go on to say that if the elite campuses were as successful as McDonald's in teaching sensibly, we would have a better world. Yep. Avoiding life's pitfalls a la Kipling. Yep. If you can keep your head when all about you are losing theirs and blaming it on you, if you can trust yourself when all men doubt you but make allowance for their doubting too, if you can wait and not be tired by waiting or being lied about, don't deal in lies or being hated, don't give way to hating, and yet don't look too good, nor talk too revise. If you can talk with crowds and keep your virtue, or walk with kings, nor lose the common touch, if neither foes nor loving friends can hurt you, if all men count with you but none too much, if you can fill the unforgiving minute with 60 seconds worth of distance run, yours is the earth and everything that's in it, and which is more you'll be a man, my son. Yep. Excerpted from the poem If, which Charlie has always admired. Yep. 177. Yep. Well known because it was published in Outstanding Investor Digest May 5, 1995. This talk was given in 1994 to Professor Guilford Babcock's business class at the University of Southern California. Charlie ranges in the talk from education systems to psychology to the importance of possessing both common and uncommon sense. Dissecting business management, he brilliantly describes psychological impacts that can damage or benefit a firm. He also presents an outstanding set of principles for investment, business management, and, most importantly, from Charlie's perspective, decision-making in everyday life. Your time investment in reading this talk will be paid back quickly via the effect it will have on your own decision-making abilities. Talk 2. A lesson on elementary, worldly wisdom as it relates to investment management and business. The University of Southern California Marshall School of Business, April 14, 1994. I am going to play a minor trick on you today, because the subject of my talk is the art of stock picking as a subdivision of the art of worldly wisdom. That enables me to start talking about worldly wisdom, a much broader topic that interests me because I think all too little of it is delivered by modern educational systems, at least in an effective way. And therefore, the talk is sort of along the lines that some behaviorist psychologists call Grandma's rule, after the wisdom of Grandma when she said that you have to eat the carrots before you get the dessert. The carrot part of this talk is about the general subject of worldly wisdom, which is a pretty good way to start. After all, the theory of modern education is that you need a general education before you specialize. And I think, to some extent, before you're going to be a great stock picker, you need some general education. The talk is sort of along the lines that some behaviorist psychologists call Grandma's rule, after the wisdom of Grandma when she said that you have to eat the carrots before you get the dessert. So, emphasizing what I sometimes waggishly call remedial, worldly wisdom, I'm going to start by waltzing you through a few basic notions. What is elementary, worldly wisdom? Well, the first rule is that you can't really know anything if you just remember isolated facts and try and bang them back. If the facts don't hang together on a latticework of theory, you don't have them in a usable form. You've got to have models in your head. And you've got to array your experience both vicarious and direct on this latticework of models. You may have noticed students who just try to remember and pound back what is remembered. Well, they fail in school and fail in life. You've got to hang experience on a latticework of models in your head. What are the models? Well, the first rule is that you've got to have multiple models. Because if you have just one or two that you're using, the nature of human psychology is such that you'll torture reality so that it fits your models, or at least you'll think it does. You become the equivalent of a chiropractor, who, of course, is the great boon in medicine. Yep. It's like the old saying to the man, with only a hammer, every problem looks like a navy, and of course, that's the way the chiropractor goes about practicing medicine. But that's a perfectly disastrous way to think, and a perfectly disastrous way to operate in the world, so you have gone to have multiple models. Yep. And the models have to come from multiple disciplines, because all the wisdom of the world is not to be found in one little academic department. That is why poetry processes, by and large, are so unwise in a worldly sense. They don't have enough models in their head, so you have got to models across the pair array of disciplines. Yep. And you may say, my God, this is already getting way too tough. But fortunately, it is not that, because 80 to 90 important models will carry about 90% of the freight in making you a worldly wise person, and of those, only a mere handful really carry very heavy freight. Yet, poetry processors, by and large, are so unwise in the world lessons. They don't have enough models in their head, so you have got to have models across the wide array of disciplines. Yep. So let's briefly review what kind of models and techniques constitutes the basic knowledge that everybody has to have before they proceed to being really good at a narrow 8-line stock picking. Yep. First, there's mathematics. Obviously, you've got to be able to handle numbers and quantities. Basic arithmetic, and the great useful model, after compound interest, is the elementary math of permutations and combinations. And that was taught in my day in the sophomore year in high school. I suppose by now, in great private schools, it's probably down to the 8th grade or so. Yep. The basic neural network of the brain is there through broad genetic and cultural evolution. And it's not Fermat/Pascal. It uses a very crude, shortcut type of approximation. It's very simple algebra. And it was all worked out in the course of about 1 year, in correspondence between Pascal and Fermat. They worked it out casually in a series of letters. Yep. It's not that hard to learn. What is hard is to get so you use it routinely almost every day of your life. The Fermat/Pascal system is dramatically consonant with the way that the world works, and its fundamental truth. So you simply have to have the technique. Yep. Invited by French aristocrat Chevalier de Merde to help resolve a gambling dispute in the mid-17th century, mathematicians Pierre de Fermat and Blaise Pascal laid the foundations for probability theory in a series of letters. De Merde's question concerned bets on rolls of a die that at least one 6 would appear during 4 rolls. From experience, he knew he would win more often than lose at this game. As a diversion, he changed the game to a bet that he would get a total of 12, or a double 6, on 24 rolls of 2 dice. The new game was less profitable than the old one. He asked the mathematicians to determine why this change occurred. Yep. Many educational institutions, although not nearly enough, have realized this. At Harvard Business School, the great quantitative thing that bonds the first-year class together is what they call decision tree theory. All they do is take high school algebra and apply it to real-life problems. And the students love it. They're amazed to find that high school algebra works in life. Yep. By and large, as it works out, people can't naturally and automatically do this. If you understand elementary psychology, the reason they can't is really quite simple. The basic neural network of the brain is there through broad genetic and cultural evolution. And it's not Fermat/Pascal. It uses a very crude, shortcut type of approximation. It's got elements of Fermat/Pascal in it. However, it's not good. So you have to learn in a very usable way this very elementary math and use it routinely in life. Just the way if you want to become a golfer, you can't use the natural swing that broad evolution gave you. You have to learn to have a certain grip and swing in a different way to realize your full potential as a golfer. If you don't get this elementary but mildly unnatural mathematics of elementary probability into your repertoire, then you go through a long life like a one-legged man in an ass-kicking contest. If you don't get this elementary but mildly unnatural mathematics of elementary probability into your repertoire, then you go through a long life like a one-legged man in an ass-kicking contest. You're giving a huge advantage to everybody else. One of the advantages of a fellow like Buffett, whom I've worked with all these years, is that he automatically thinks in terms of decision trees and the elementary math of permutations and combinations. Obviously, you have to know accounting. It's the language of practical business life. It was a very useful thing to deliver to civilization. I've heard it came to civilization through Venice, which, of course, was once the great commercial power in the Mediterranean. However, debentry bookkeeping was a hell of an invention. And it's not that hard to understand. But you have to know enough about it to understand its limitations, because although accounting is the starting place, it's only a crude approximation. And it's not very hard to understand its limitations. For example, everyone can see that you have to more or less just guess at the useful life of a jet airplane or anything like that. Just because you express the depreciation rate in neat numbers doesn't make it anything you really know. In terms of the limitations of accounting, one of my favorite stories involves a very great businessman named Carl Braun, who created the C.E. Braun Engineering Company. It designed and built oil refineries, which is very hard to do. And Braun would get them to come in on time and not blow up and have efficiencies and so forth. This is a major art. And Braun, being the thorough Teutonic type that he was, had a number of quirks. And one of them was that he took a look at standard accounting and the way it was applied to building oil refineries, and he said, "This is asinine." So he threw all of his accountants out, and he took his engineers and said, "Now, we'll devise our own system of accounting to handle this process." And in due time, accounting adopted a lot of Carl Braun's notions. So he was a formidably willful and talented man, who demonstrated both the importance of accounting and the importance of knowing its limitations. He had another rule from psychology, which, if you're interested in wisdom, ought to be part of your repertoire like the elementary mathematics of permutations and combinations. His rule for all the Braun Company's communications was called the 5 Ws. You had to tell who was going to do what, where, when, and why. And if you wrote a letter or directive in the Braun Company telling somebody to do something, and you didn't tell him why, you could get fired. In fact, you would get fired if you did it twice. You might ask, why is that so important? Well, again, that's a rule of psychology. Just as you think better if you array knowledge on a bunch of models that are basically answers to the question, why, if you always tell people why, they'll understand it better, they'll consider it more important, and they'll be more likely to comply. Even if they don't understand your reason, they'll be more likely to comply. If you always tell people why, they'll understand it better, they'll consider it more important, and they'll be more likely to comply. So there's an iron rule that just as you want to start getting worldly wisdom by asking why in communicating with other people about everything, you want to include why. Even if it's obvious, it's wise to stick in the why. Which models are the most reliable? Well, obviously, the models that come from hard science and engineering are the most reliable models on this earth. And engineering quality control, at least the guts of it that matters to you and me, and people who are not professional engineers, is very much based on the elementary mathematics of Fermat and Pascal. It costs so much, and you get so much less likelihood of it breaking if you spend this much. It's all elementary high school mathematics. And an elaboration of that is what Deming brought to Japan for all of that quality control stuff. I don't think it's necessary for most people to be terribly facile in statistics. For example, I'm not sure that I can even pronounce the Gaussian distribution, although I know what it looks like, and I know that events and huge aspects of reality end up distributed that way. So I can do a rough calculation. But if you ask me to work out something involving a Gaussian distribution to 10 decimal points, I can't sit down and do the math. I'm like a poker player who's learned to play pretty well without mastering Pascal. And by the way, that works well enough. But you have to understand that bell-shaped curve at least roughly as well as I do. And of course, the engineering idea of a backup system is a very powerful idea. The engineering idea of breakpoints, that's a very powerful model, too. The notion of a critical mass that comes out of physics is a very powerful model. All of these things have great utility in looking at ordinary reality. And all of this cost-benefit analysis hell, that's all elementary high school algebra. It's just been dolled up a little bit with fancy lingo. And you can demonstrate that point quite simply. There's not a person in this room viewing the work of a very ordinary professional magician who doesn't see a lot of things happening that are not happening and not see a lot of things happening that are happening. I suppose the next most reliable models are from biology physiology because, after all of us are programmed by our genetic makeup to be much the same. And then when you get into psychology, of course, it gets very much more complicated. But it's an ungodly important subject if you're going to have any worldly wisdom. And the reason why is that the perceptual apparatus of man has shortcuts and the brain cannot have unlimited circuitry. So someone who knows how to take advantage of those shortcuts and cause the brain to miscalculate in certain ways can cause you to see things that aren't there. Now you get into the cognitive function as distinguished from the perceptual function. And there you are equally more than equally in fact likely to be misled. Again, your brain has a shortage of circuitry and so forth, and it's taking all kinds of little automatic shortcuts. So when circumstances combine in certain ways or more commonly, your fellow man starts acting like the magician and manipulates you on purpose by causing you cognitive dysfunction. You're a patsy. And so just as a man working with a tool has to know its limitations, a man working with his cognitive apparatus has to know its limitations. And this knowledge, by the way, can be used to control and motivate other people. The mind of man at one and the same time is both the glory and the shame of the universe. So the most useful and practical part of psychology, which I personally think can be taught to any intelligent person in a week, is ungodly important. And nobody taught it to me, by the way. I had to learn it later in life, one piece at a time. And it was fairly laborious. It's so elementary, though, that, when it was all over, I just felt like a total horse's ass. And yeah, I'd been educated at Caltech and the Harvard Law School and so forth. So very eminent places, miseducated people like you and me. The elementary part of psychology, the psychology of misjudgment, as I call it, is a terribly important thing to learn. There are about 20 little principles. And they interact, so it gets slightly complicated. But the guts of it is unbelievably important. Very smart people make totally bonkers mistakes by failing to pay heed to it. In fact, I've done it several times during the last 2 or 3 years in a very important way. You never get totally over making silly mistakes. Here's another saying that comes from Pascal that I've always considered one of the really accurate observations in the history of thought. Pascal said, "The mind of man at one and the same time is both the glory and the shame of the universe." Yep. And that's exactly right. It has this enormous power. However, it also has these standard malfunctions that often cause it to reach wrong conclusions. It also makes man extraordinarily subject to manipulation by others. For example, roughly half of the army of Adolf Hitler was composed of believing Catholics. Given enough clever psychological manipulation, what human beings will do is quite interesting. I now use a kind of two-track analysis. Personally, I've gotten so that I now use a kind of two-track analysis. First, what are the factors that really govern the interests involved, rationally considered? And second, what are the subconscious influences where the brain at a subconscious level is automatically doing these things, which, by and large, are useful but which often misfunction? One approach is rationality, the way you'd work out a bridge problem, by evaluating the real interests, the real probability, and so forth. And the other is to evaluate the psychological factors that cause subconscious conclusions, many of which are wrong. Now we come to another, somewhat less reliable form of human wisdom microeconomics. And here, I find it quite useful to think of a free market economy, partly free market economy as sort of the equivalent of an ecosystem. Just as animals flourish in niches, similarly, people who specialize in the business world and get very good because they specialize frequently find good economics that they wouldn't get any other way. This is a very unfashionable way of thinking because early in the days after Darwin came along, people like the robber barons assumed that the doctrine of the survival of the fittest authenticated them as deserving power. You know, I'm the richest. Therefore, I'm the best. God's in his heaven, etc. And that reaction of the robber barons was so irritating to people that it made it unfashionable to think of an economy as an ecosystem. But the truth is that it is a lot like an ecosystem, and you get many of the same results. Just as in an ecosystem, people who narrowly specialize can get terribly good at occupying some little niche. Just as animals flourish in niches, similarly, people who specialize in the business world and get very good because they specialize frequently find good economics that they wouldn't get any other way. And once we get into microeconomics, we get into the concept of advantages of scale. Now we're getting closer to investment analysis, because in terms of which businesses succeed and which businesses fail, advantages of scale are ungodly important. For example, one great advantage of scale taught in all of the business schools of the world is cost reductions along the so-called experience curve. Just doing something complicated in more and more volume enables human beings, who are trying to improve and are motivated by the incentives of capitalism, to do it more and more efficiently. The very nature of things is that if you get a whole lot of volume through your operation, you get better at processing that volume. That's an enormous advantage. The very nature of things is that if you get a whole lot of volume through your operation, you get better at processing that volume. That's an enormous advantage. And it has a lot to do with which businesses succeed and fail. Let's go through a list, albeit an incomplete one, of possible advantages of scale. Some come from simple geometry. If you're building a great circular tank, obviously, as you build it bigger, the amount of steel you use in the surface goes up with the square, and the cubic volume goes up with the cube. So as you increase the dimensions, you can hold a lot more volume per unit area of steel. And there are all kinds of things like that where the simple geometry, the simple reality, gives you an advantage of scale. For example, you can get advantages of scale from TV advertising. When TV advertising first arrived, when talking color pictures first came into our living rooms, it was an unbelievably powerful thing. And in the early days, we had 3 networks that had whatever it was, say, 90% of the audience. Yep. Am I going to take something I don't know and put it in my mouth, which is a pretty personal place, after all, for a lousy dime? Yep. Well, if you were Procter & Gamble, you could afford to use this new method of advertising. You could afford the very expensive cost of network television because you were selling so damn many cans and bottles. Some little guy couldn't. And there was no way of buying it in part. Therefore, he couldn't use it. In effect, if you didn't have a big volume, you couldn't use network TV advertising, which was the most effective technique. So when TV came in, the branded companies that were already big got a huge tailwind. Indeed, they prospered and prospered and prospered until some of them got fat and foolish, which happens with prosperity at least to some people. And your advantage of scale can be an informational advantage. If I go to some remote place, I may see Wrigley chewing gum alongside Glotz's chewing gum. Well, I know that Wrigley is a satisfactory product, whereas I don't know anything about Glotz's. So if one is 40 cents and the other is 30 cents, am I going to take something I don't know and put it in my mouth, which is a pretty personal place, after all, for a lousy dime? Yep. So in effect, Wrigley, simply by being so well knowledge, has advantage of scale, what we might call an informational advantage. Another advantage of scale comes from psychology. The psychologists use the term social proof. We are all influenced subconsciously, and to some extent, consciously we see others do and approve. Therefore, if everybody's buying something, we think it's better. We don't like to be the one guy who's out of step. Again, some of this is at a subconscious level, and some of it isn't. Sometimes consciously and rationally think, God, I didn't know much about this. They know more than I do. Therefore, why shouldn't I follow them? Yep. The social proof phenomenon, which comes right out of psychology, gives huge advantage to scale, for example, with very wide distribution, which course is hard to get. One advantage of Coca-Cola is that it's available almost everywhere in the world. Yep. Well, suppose you have a little soft drink. Exactly how do you make it available all over the earth? The worldwide distribution setup, which is slowly won by big enterprise games, to be a huge advantage. And if you think about it, once you get enough advantages of that type, it can become very hard for anybody to dislodge you. Yep. There's another kind of advantage of scale in some businesses. The very nature of things is to sort of cascade towards the overwhelming dominance of one. For the other obvious one is daily newspaper. There is practically no city left in the United States aside from few very big ones where there is more than one daily newspaper. Yep. And again, that as a scale, think once I get most of the circulation, I get most of the advertising. And once I get most of the advertising and circulation, why would anyone want the thinner paper with less information in it? So it tends to cascades to a winner-take-all situation, and that is a separate form of advantages of scale phenomenon. Yep. Similarly, all these huge advantages of scale allow greater specialization within the firm. Therefore, each person can be better at what he does. And these advantages of scale are so great, for example, that when Jack Welch came into General Electric, he just said, "The hell with it. We're either going to be L or 2 in every field we're in, or we're going to be out. I don't care how many people I have to fire and what I have to sell. We're going to be 1 or 2 or out." Yep. The Saturday Evening Post and all those things are gone. What we have now is motocross, which is read by a bunch of nuts who like to participate in tournaments where they turn somersaults on their motorcycles. Yep. That was a very tough-minded thing to do, but I think it was a very correct decision if you're thinking about maximizing shareholder wealth. And I don't think it's a bad thing to do for a civilization either, because I think that General Electric is stronger for having Jack Welch there. And there are also disadvantages of scale. For example, we, by which I mean Berkshire Hathaway, are the largest shareholder in Capital Cities ABC, and have had trade publications there that got murdered, where our competitors beat us. And the way they beat us was by going to a narrower specialization. We'd have a travel magazine for business travel. So somebody would create one which was addressed solely at corporate travel departments. Like an ecosystem, you're getting a narrower and narrower specialization. 194. When they got much more efficient, they could tell more to the guys who ran corporate travel departments. Plus, they did not have to waste the ink and paper mailing out stuff that corporate travel departments are not interested in reading. It was a more efficient system, and they beat our brains out as we relied on our production. That is what happened to the Saturday Evening Post, and all those things. They are gone, but we have now is motocross, which is read by a bunch of nuts would like to participate in tournaments where they turned somersaults on their motorcycles. But they care about it, for then it is the principal purpose of life. A magazine called Motocross is a total necessity to those people, and its profit margins would make you celebrate. Just think of how narrow cast that kind of publishing is. So occasionally scaling down and intensifying gives you the big advantage. Bigger is not always better. The great defect of scale, of course, which makes the game interesting, so that the big people don't always win, is that as you get big you get the bureaucracy. And with the bureaucracy comes the territoriality, which is again grounded in human nature. The big people don't always win, is that as you get big you get the bureaucracy. And then incentives are perverse. For example, if you worked for a T&T in my day, it was a great bureaucracy. Who in the hell was really thinking about the shareholder or anything else? And in a bureaucracy, you think the work is done when it goes out of your in-basket to somebody else. In-basket, but of course it isn't. It's not done until AT&T delivers what it's supposed to deliver. Big, fat, dumb, unmotivated bureaucracies. They also tend to become somewhat corrupt. In other words, if I've got a department and you've got a department and we kind of share power running this thing, there's sort of an unwritten rule. If you won't bother me, I won't bother you, and we're both happy. So you get layers of management and associated costs that nobody needs. Then, while people are justifying all these lawyers, it takes forever to get anything done. They're too slow to make decisions, and nimbler people run circles around them. Television was dominated by one network, CBS, in its early days. The constant curse of scale is that it leads to big, dumb bureaucracy, which, of course, reaches its highest and worst form in government, where the incentives are really awful. That doesn't mean we don't need government, because we do. But it's a terrible problem to get big bureaucracies to behave. So people go to stratagems. They create little decentralized units and fancy motivation and training programs. For example, for a big company, General Electric has fought bureaucracy with amazing skill. But that's because they have a combination of a genius and a fanatic running it. And they put him in young enough so he gets a long run. Of course, that's Jack Welch. But bureaucracy is terrible. And as things get very powerful and very big, you can get some really dysfunctional behavior. Look at Westinghouse. They blew billions of dollars on a bunch of dumb loans to real estate developers. They put some guy who'd come up by some career path. I don't know exactly what it was, but it could have been refrigerators or something. And all of a sudden, he's loaning money to real estate developers building hotels. It's a very unequal contest. And in due time, they lost all those billions of dollars. CBS provides an interesting example of another rule of psychology, namely Pavlovian association. If people tell you what you really don't want to hear, what's unpleasant there is an almost automatic reaction of antipathy. You have to train yourself out of it. It isn't foredestined that you have to be this way. But you will tend to be this way if you don't think about it. Yep. Television was dominated by one network, CBS, in its early days. And Paley was a god. But he didn't like to hear what he didn't like to hear, and people soon learned that. So they told Paley only what he liked to hear. Therefore, he was soon living in a little cocoon of unreality, and everything else was corrupt, although it was a great business. So the idiocy that crept into the system was carried along by this huge tide. It was a Mad Hatter's Tea Party the last 10 years under Bill Paley. And that is not the only example, by any means. You can get severe misfunction in the high ranks of business. And of course, if you're investing, it can make a hell of a lot of difference. If you take all the acquisitions that CBS made under Paley after the acquisition of the network itself, with all his dumb advisors, his investment bankers, management consultants, and so forth, who were getting paid very handsomely, it was absolutely terrible. So life is an everlasting battle between those two forces to get these advantages of scale on one side, and a tendency to get a lot like the U.S. Agriculture Department on the other side, where they just sit around and so forth. I don't know exactly what they do. However, I do know that they do very little useful work. On the subject of advantages of economies of scale, I find chain stores quite interesting. Just think about it. The concept of a chain store was a fascinating invention. You get this huge purchasing power, which means that you have lower merchandise costs. You get a whole bunch of little laboratories out there in which you can conduct experiments. And you get specialization. If one little guy is trying to buy across 27 different merchandise categories influenced by traveling salesmen, he's going to make a lot of dumb decisions. But if your buying is done in headquarters for a huge bunch of stores, you can get very bright people that know a lot about refrigerators and so forth to do the buying. The reverse is demonstrated by the little store, where one guy is doing all the buying. It's like the old story about the little store with salt all over its walls. And a stranger comes in and says to the store owner, "You must sell a lot of salt." And he replies, "No, I don't. But you should see the guy who sells me salt." So there are huge purchasing advantages. And then there are the slick systems of forcing everyone to do what works. So a chain store can be a fantastic enterprise. How does a guy in Bentonville, Arkansas, with no money, blow right by Sears Roebuck? And he does it in his own lifetime, in fact, during his own late lifetime, because he was already pretty old by the time he started out with one little store. It's quite interesting to think about Walmart starting from a single store in Arkansas against Sears Roebuck with its name, reputation, and all of its billions. How does a guy in Bentonville, Arkansas, with no money, blow right by Sears Roebuck? And he does it in his own lifetime, in fact, during his own late lifetime, because he was already pretty old by the time he started out with one little store. He played the chain store game harder and better than anyone else. Walton invented practically nothing. But he copied everything anybody else ever did that was smart, and he did it with more fanaticism and better employee manipulation. So he just blew right by them all. 198. He also had a very interesting competitive strategy in the early days. He was like a prize fighter who wanted a great record, so he could be in the finals and make a big TV hit. So what did he do? He went out and fought 42 palookas. Right. And the result was knockout, knockout, knockout 42 times. Walton, being as shrewd as he was, basically broke other small-town merchants in the early days. With his more efficient system, He might not have been able to tackle some titan head-on at the time. But with his better system, he could sure as hell destroy those small-town merchants. And he went around doing it time after time after time. Then, as he got bigger, he started destroying the big boys. Well, that was a very, very shrewd strategy. You can say, is this a nice way to behave? Well, capitalism is a pretty brutal place. But I personally think that the world is better for having Walmart. I mean, you can idealize small-town life. But I've spent a fair amount of time in small towns. And let me tell you, you shouldn't get too idealistic about all those businesses he destroyed. Plus, a lot of people who work at Walmart are very high-grade, bouncy people who are raising nice children. I have no feeling that an inferior culture destroyed a superior culture. I think that is nothing more than nostalgia and delusion. But at any rate, it's an interesting model of how the scale of things and fanaticism combine to be very powerful. And it's also an interesting model on the other side how, with all its great advantages, the disadvantages of bureaucracy did such terrible damage to Sears. Roebuck. Sears had layers and layers of people it didn't need. It was very bureaucratic. It was slow to think. And there was an established way of thinking. If you poked your head up with a new thought, the system kind of turned against you. It was everything in the way of a dysfunctional big bureaucracy that you would expect. In all fairness, there was also much that was good about it. But it just wasn't as lean and mean and shrewd and effective as Sam Walton. And in due time, all Sears' advantages of scale were not enough to prevent it from losing heavily to Walmart and other similar retailers. The net amount of money that's been made by the shareholders of airlines since Kitty Hawk is now a negative figure. Here's a model that we've had trouble with. Maybe you'll be able to figure better. Many markets get down to 2 or 3 big competitors, or 5 or 6. And in some of those markets, nobody makes any money to speak of. But in others, everybody does very well. Over the years, we've tried to figure out why the competition in some markets gets sort of rational from the investor's point of view so that the shareholders do well, while in other markets there's destructive competition that destroys shareholder wealth. If it's a pure commodity like airline seats, you can understand why no one makes any money. As we sit here, us think of what airlines have given to the world: safe travel, greater experience, time with your loved ones, you name it. Yet the net amount of money that's been made by the shareholders of airlines since Kitty Hawk is now a negative figure, a substantial negative figure. Competition was so intense that, once it was unleashed by deregulation, it ravaged shareholder wealth in the airline business. Yet in other fields like cereals, for example, almost all the big boys make out. If you're some kind of a medium-grade cereal maker, you might make 15% on your capital. And if you're really good, you might make 50%. But why are cereals so profitable, despite the fact that it looks to me like they're competing like crazy with promotions, coupons, and everything else? I don't fully understand it. Obviously, there's a brand identity factor in cereals that doesn't exist in airlines. That must be the main factor that accounts for it. And maybe the cereal makers, by and large, have learned to be less crazy about fighting for market share, because if you get even one person who's hell-bent on gaining market share. For example, if I were Kellogg and I decided that I had to have 60% of the market, I think I could take most of the profit out of cereals. I'd ruin Kellogg in the process. But I think I could do it. In some businesses, the participants behave like a demented Kellogg. In other businesses, they don't. Unfortunately, I do not have a perfect model for predicting how that's going to happen. 201. For example, if you look around at bottler markers, you'll find many markets where bottlers of Pepsi and Coke both make a lot of money, and many others where they destroy most of the profitability of the two franchises. That must get down to the peculiarities of individual adjustment to market capitalism. I think you'd have to know the people involved to fully understand what was happening. In microeconomics, of course, you've got the concept of patents, trademarks, exclusive franchises, and so forth. Patents are quite interesting. When I was young, I think more money went into patents than came out. Judges tended to throw them out based on arguments about what was really invented and what relied on prior art. That isn't altogether clear. But they changed that. They didn't change the laws. They just changed the administration so that it all goes to one patent court. And that court is now very much more pro-patent. So I think people are now starting to make a lot of money out of owning patents. Trademarks, of course, have always made people a lot of money. A trademark system is a wonderful thing for a big operation if it's well known. The exclusive franchise can also be wonderful. If there were only 3 television channels awarded in a big city and you owned one of them, there were only so many hours a day that you could be on. So you had a natural position in an oligopoly in the pre-cable days. And if you get the franchise for the only food stand in an airport, you have a captive clientele, and you have a small monopoly of a sort. The great lesson in microeconomics is to discriminate between when technology is going to help you and when it's going to kill you. And most people do not get this straight in their heads. But a fellow like Buffett does. For example, when we were in the textile business, which is a terrible commodity business, we were making low-end textiles, which are a real commodity product. And one day, the people came to Warren and said, "They've invented a new loom that we think will do twice as much work as our old ones." And Warren said, "Gee, I hope this doesn't work, because if it does, I'm going to close the mill." And he meant it. The great lesson in microeconomics is to discriminate between when technology is going to help you and when it's going to kill you. What was he thinking he was thinking? It's a lousy business. We're warning substandard returns and keeping it open just to be nice to the elderly workers. But we're not going to put huge amounts of new capital into a lousy business. And he knew that the huge productivity increases that would come from a better machine introduced into the production of a commodity product would all go to the benefit of the buyers of the textiles. Nothing was going to stick to our ribs as owners. They don't do the second step of the analysis, which is to determine how much is going to stay home and how much is just going to flow through to the customer. That's such an obvious concept, that there are all kinds of wonderful new inventions that give you nothing as owners except the opportunity to spend a lot more money in a business that's still going to be lousy. The money still won't come to you. All of the advantages from great improvements are going to flow through to the customers. Conversely, if you own the only newspaper in Oshkosh and they were to invent more efficient ways of composing the whole newspaper, then when you got rid of the old technology and got new fancy computers and so forth, all of the savings would come right through to the bottom line. In all cases, the people who sell the machinery and, by and large, even the internal bureaucrats urging you to buy the equipment show you projections with the amount you'll save at current prices with the new technology. However, they don't do the second step of the analysis, which is to determine how much is going to stay home and how much is just going to flow through to the customer. I've never seen a single projection incorporating that second step in my life. And I see them all the time. Rather, they always read, "This capital outlay will save you so much money that it will pay for itself in 3 years." So you keep buying things that will pay for themselves in 3 years. And after 20 years of doing it, somehow you've earned a return of only about 4% per annum. That's the textile business. Yep. And it isn't that the machines weren't better. It's just that the savings didn't go to you. The cost reductions came through all right. But the benefit of the cost reductions didn't go to the guy who bought the equipment. It's such a simple idea. Yep. It's so basic. And yet it's so often forgotten. Yep. Then there's another model from microeconomics that I find very interesting. When technology moves as fast as it does in a civilization like ours, you get a phenomenon chat I call competitive destruction. You know, you have the finest buggy whip factory, and all of a sudden, in comes this little horseless carriage. And before too many years go by, your buggy whip business is dead. You either get into a different business or you're destroyed. It happens again and again and again. Yep. And when these new businesses come in, there are huge advantages for the early birds. And when you're an early bird, there's a model that I call surfing. When a surfer gets up and catches the wave and just stays there, he can go a long, long time. But if he gets off the wave, he becomes mired in shallows. But people get long runs when they're right on the edge of the wave, whether it's Microsoft or Intel or all kinds of people, including National Cash Register in the early days. Yep. The cash register was one of the great contributions to civilization. It's a wonderful story. Patterson was a small retail merchant who didn't make any money. One day, somebody sold him a crude cash register, which he put into his retail operation. And it instantly changed from losing money to earning a profit because it made it so much harder for the employees to steal. But Patterson, having the kind of mind that he did, didn't think, "Oh, good for my retail business." He thought, "I'm going into the cash register business." And of course, he created National Cash Register. And he surfed. He got the best distribution system, the biggest collection of patents, and the best of everything. He was a fanatic about everything important as the technology developed. I have in my files an early National Cash Register Company report in which Patterson described his methods and objectives. And a well-educated orangutan could see that buying into partnership with Patterson in those early days, given his notions about the cash register business, was a total 100% cinch. And of course, that's exactly what an investor should be looking for. In a long life, you can expect to profit heavily from at least a few of those opportunities if you develop the wisdom and will to seize them. At any rate, surfing is a very powerful model. Yep. However, Berkshire Hathaway, by and large, does not invest in these people that are surfing on complicated technology. After all, we're cranky and idiosyncratic, as you may have noticed. Yep. And Warren and I don't feel like we have any great advantage in the high-tech sector. In fact, we feel like we're at a big disadvantage in trying to understand the nature of technical developments in software, computer chips, or what have you. So we tend to avoid that stuff, based on our personal inadequacies. Again, that is a very, very powerful idea. Every person is going to have a circle of competence, and it's going to be very hard to enlarge that circle. If I had to make my living as a musician, I can't even think of a level low enough to describe where I would be sorted out to if music were the measuring standard of the civilization. So you have to figure out what your own aptitudes are. If you play games where other people have the aptitudes and you don't, you're going to lose. And that's as close to certain as any prediction that you can make. You have to figure out where you've got an edge. And you've got to play within your own circle of competence. Yep. Warren and I don't feel like we have any great advantage in the high-tech sector. Yep. If you want to be the best tennis player in the world, you may start out trying and soon find out that it's hopeless, that other people blow right by you. However, if you want to become the best plumbing contractor in Bemidji, that is probably doable by 2/3 of you. It takes a will. It takes the intelligence. But after a while, you'd gradually know all about the plumbing business in Bemidji and master the art. That is an attainable objective, given enough discipline. And people who could never win a chess tournament or stand in center court in a respectable tennis tournament can rise quite high in life by slowly developing a circle of competence, which results partly from what they were born with and partly from what they slowly develop through work. So some edges can be acquired. And the game of life, to some extent for most of us, is trying to be something like a good plumbing contractor in Bemidji.